I'm with Paul Santori. He makes over $10,000 a month in passive income. He has a total book cost of $436,000 to generate that income. So make sure you use the chapters below so you can just bounce around between each ETF. Let's jump right into it. Paul, thanks for being here. And ETF number one that generates you the most income is MSTE, the Harvest MicroStrategy Enhanced High Income Shares ETF. Monthly dividend, $1,487. Annual dividend, $17,853. Your book cost, $43,000 or so. Shares, $2,650. Distribution, 55 cents per share. Everyone watching probably knows the share got slightly slashed, so we were just talking about that off camera. And jump into it. It's your portfolio weights about 10% of your portfolio. Why'd you buy this? This is high risk. People ask me this question all the time as well.
Hey, Gary, thanks for inviting me. And sure, let's jump right into it. Well, first of all, I really like Harvest. I think, they've been an amazing ETF provider. They have such a great suite of options. And MSTE, why did I buy it? Because it had the highest distribution, right? Started out at 60 cents. How could you go wrong on a $12, per share ETF? Something ridiculous like a 45 or a 50% yield. So,
Yeah.
and the second month, they increased the dividend to 66, right? It was crazy. It went up, I think, for 2 months, and then they brought it back to 60. And as you said, they did cut it to 55. So all of a sudden, I got flooded with messages on Blossom, people asking me, should I sell? What should I do? I'm losing money. That's not the covered call strategy, right? You buy, you collect the distributions, you buy more, you keep collecting more distributions. Maybe you diversify, use those distributions to buy something else. But in the long run, you will come out ahead.
How did you buy this one? We're talking about this. I was checking my portfolio really quickly. I'm looking on my phone here. I'm not ignoring Paul. I'm just pulling up how much I have of MSTE. Have you been averaging down since it's been dropping? I'm just pulling up my portfolio.
Yeah, you know what, Gary? I did get to the point where I was happy with my position and I wasn't really going to buy any more. But then all of a sudden, I think CNYE started skyrocketing and MSTE was coming down. So it was like, okay, I'm going to sell 100 of these and I'm going to buy 100 of those and I'm going to increase my monthly, and decrease my my average cost.
Okay, so I've been doing the same thing. I'm just pulling it up right here. Okay, so MSTE, I have. You have, what do we have here? We have $43,000 book cost. I have $40,000, 283. $240,283.16. My market value for that now is about $36,000. So I'm down $4,337. But like you, I'm not I don't see it's covered call strategy. And my quantity is I have 2,920 shares of this. And my average cost is $13.79. So I've been bringing that cost.
Mine. Yeah, yours is way better than mine. I think mine's over 15.
I think I started buying at 15.
Yeah.
And I was like, I'm done. Because this is too much volatility. I'm done. And here's where maybe I should have caught myself while I was doing this. If I see prices go down on stocks I'm holding, I instinctively just buy more. I never buy it when it's going higher, and that's growth investor in me. So I just couldn't help myself. So every week it's been going down. I've been just dumping $5,000 on it, $5,000 increments. And I thought I'd be done after one $5,000 increment. And I was like, oh yeah, I'll just do another one. And then yesterday I did it. And then I was thinking, even when I was doing it yesterday, I'm like, this is going to keep going down. Why don't I just let it keep going? I was like, whatever. And I guess I'm at the point now, I don't know, I want to hear your thoughts. Should I stop? Or should I just keep averaging down?
That's a great question. And a lot of people wonder stuff like that. So what you have to do is you have to look at your portfolio as a whole, right? And if MSTE is 50, 60, 70% of your portfolio, then you should probably stop. You might have a problem. But if it's only 5% of your portfolio, 10% of your portfolio, and you're okay with that amount of risk, then buy more. Why not, right? I don't see the problem. Unless you think Bitcoin's done, right? Or you think strategy's done, well, then we're in a lot of trouble. But sounds like September is just a blah month for investments in general. So if we can get through September,
I think
September be pretty happy. Sorry, you might be pretty happy on the other side of it.
I think September, depending on how you look at it, is a good buying month. So I've been reserving capital for September. I guess I'll just say this out loud. I have in the high six figures of just cash sitting there.
Yeah.
And I just have it sitting there, and I've been tempted to buy stuff throughout the year. I bought a bunch in April because I was like, oh, that's good. But I was like, okay, well, September's rolling around. And this isn't for covered call ETFs. I'm using this. This is for other stuff. This is more for value investing, growth investing, stuff like that. And I'm sort of just watching what happens the next month or two. And if I find opportunities, I'll be buying it. And now it's still like in September. For the covered call, that's a good point. Now, where does this factor into your portfolio? Personally, for me, I don't, I guess I don't consider my covered call portion of my portfolio like my portfolio. It's not what I rely on for my retirement right now because I have my TFSA, my RRSP maxed out with other stuff in corp accounts. This is a non-registered. Where are you keeping this stuff? Your MST at least.
So unlike you, this is everything I have, right? I don't have growth investments. I don't have other portfolios. Everything I own, I've put into covered calls. So I don't just, I didn't just get on the Blossom or onto YouTube, to talk about covered call investing because I thought it was a hot topic, right? This is everything I have. And, but obviously I keep all of it in my TFSA and my RSP. That way I don't pay tax on it. Because a lot of people ask me questions about tax. I never really think about the tax because I'm not paying tax. I have a very small cash account with about $22,000 in it. So it kicks off about $600 a month in distributions. And it's not really.
How old are you?
I'm 52.
Yeah, but then we were just talking, you're basically retired at this point.
The company I've been with for 23 years, we went from about 70 clients. We work with individuals in care down to 7. So the company itself has not been doing well. It's been poorly managed. And the last program I was working in shut down. So there's no more work for me. So as of Monday, I'm not working at the moment. Will I pick up another job? Possibly. But if not, then I'm trying to figure out my budget on how I can extract enough income from my portfolio and still have enough to reinvest.
Yeah, that makes sense. Actually, I think a lot of my portfolio by the time I'm 50 will be more in this strategy right now. I'm 39 right now. So I'm actually more or less using like a 5 to 10 year window of really focusing on growth investing. Then I'm converting that over when I'm around a little bit or closer to your age, maybe a little sooner, maybe like at 50 to more of an aggressive income based portfolio. Now, the reason why I actually have I have about 100K or so in non-registered, I'm getting taxed to hell with all this stuff, is because I kind of just had a thing where I was like, I the mentality shift. I'm like, I'm tired of always planning on like delayed gratification. I'm like, I'm just going to use this money in 40 years. I'm like, why can't I just have a portion of my portfolio right now that is this strategy? That is, because I have an emergency fund. I'm like, why don't I just convert my emergency fund into a covered call strategy? And because I'm never going to use a lump sum of 100K. I'm like, but that's something that's income generating, that's feeding into itself. Everything's on a drip, or I don't have it on drip. I'm just actually manually reinvesting everything because I don't know where I'm allocating. But I was like, and if I ever want to go, I just don't want to invest this month. I'm going to take all my dividends and take my family on vacations because I am alive right now. And I don't want to feel, it is for that. It's like, it's almost freeing in a way. I've been so tightly wound with money because I know what it feels like to not have money. I'm so afraid to spend it. I'm like, maybe this will be my thing. This is like my pathway to enjoying my life more. It's like I have this portfolio that's covered call that I'm paying taxes on. It's whatever. And I have peace of mind because it's not actually my TFSA RSP because I'm a little bit young. I'm like, I still have those growth investments in my corp account as well. That I'm like, oh yeah, I'll still be fine when I'm 50, whatever, because I have growth. But today, right now, sure, maybe everyone says, like Adriano will say it appreciates the same way from dividends reinvested as growth. Probably, who knows? But even if it doesn't, I'm okay because the value of living right now, enjoying the moment, means something where I kind of like knowing that I can just then take from that investment, splurge a little bit, and then go right back to reinvesting in it. And that's its purpose. It's in my brain. And it's like so I think there's a portion of understanding where it fits in your portfolio. For me, it's not my retirement. I'm depending on retirement, but it is to increase my quality of life today. It's, and you mentioned, like, let's say I run a business. Imagine if my business collapsed. It'd be nice knowing that I have a covered call portfolio to be like, hey, you can just cover my expenses till I figure stuff out for a while.
Yeah, exactly. Right.
Right?
I mean, a month ago, I didn't plan on being unemployed today. Right. But because of the strategy that I don't have to change anything. I don't have to change my investments. I don't have to start selling shares of growth funds. And to your point, for the last year or two, I've been using, like this year so far, I've taken out almost 12,000 from my portfolio. So where other people
Yep.
are going to work, they're working hard so they can invest into their portfolio. I've actually been pulling money out. Right. We went to Aruba. We went to Japan. We're going on a
Mhm.
cruise. It was my wife's birthday on Saturday. She wanted to go see Morgan Wallen. So we're going to see Morgan Wallen. Yeah, it's great. It's that's the whole trade-off, right? As opposed to having $2 or $3 million when I'm 65, I have money now that I can enjoy while I'm young, right? While I'm young enough to enjoy it, I have it now. So I think it's a great trade-off.
We'll talk after this podcast. I'll get because I'm in advertising and marketing, I know how to extract income from just like even what we do. So I'm not sure where you're at for your YouTube revenue, but I can get you up to a couple grand a month out of your YouTube channel as well, and that'll be passive. So yeah,
That would be great.
well, that's my thank you for being on the podcast. So
That'd be great.
I always talk to our guests afterwards, be like, hey man, I can help you with marketing. So let's talk about that. We'll work together off camera about that. But so you can scale into that. So you have that sort of now in your pocket as well.
Yeah.
So okay, so you have that. So we talk about I don't know, I kind of want to keep talking about MSTE a little bit because it's the most volatile. And I guess it's on top of my mind as well. So we talked about even off camera, I'm down 4,000 something. You're down whatever you're down as
Same.
well.
Yeah.
About roughly, it'll be roughly the same. And you said it doesn't bother you, right? It doesn't really bother me. You talk about why it doesn't bother you. I'll talk about why it doesn't bother me.
Yeah. You know what? It doesn't bother me. And when you think about it, everybody likes to quote Warren Buffett. And I think one of the things Warren Buffett talks about is if you buy a stock, you have to be prepared to see that stock drop like 50% because the market's just that volatile and unpredictable. And sometimes it has nothing to do with the company itself, right? The share price just goes up and down. People on a whim buy and sell. Personally, Gary, I don't understand this whole panic selling. Why am I panic
Yeah.
selling? I don't get that, right? It's the silliest thing you can do, right? And it could be covered calls or it could be Apple stock, right? My wife has Apple stock. It was up to $260 a share. I was thinking, well, maybe we should sell. And then a month later, it went down to 175. So it doesn't matter
Yeah.
what you hold, you can see swings like that. So if you can't stomach the volatility, seeing it go up and go down, yeah, you probably shouldn't be investing to begin with because you're going to make bad decisions and panic sell. Yeah, so it doesn't bother me.
I Yeah, I found this as a good test for that thing, stomach the volatility, because the
Yeah.
first thing I was told, especially after I spoke with Adriana, was like, hey, can you stomach the volatility?
Yeah.
And then I spoke with Mark Farfan, who's a crypto guy. He's like, dude, if you can stomach the volatility. Now I have crypto and covered call. Can I double stomach the volatility? So I never once for a second thought, oh, I gotta sell. My initial reaction was like, oh, I gotta buy more because it's going down. Because crypto is sort of cyclical. It has these 4-year runs, and I'm probably a little bit wrong about this because I'm not the crypto guy, but it goes like it has a 4-year arc it has.
Yeah.
So we're at the bad end of that cycle where now people are selling and it's kind of crashing a bit, I guess. And remember, I'm not the crypto guy. Do not quote me on anything.
Yeah.
So I'm like, all right, cool. Only thing that pains me, and this is, like I said, do I have a problem is I only allocated like 100, not only, that's a lot of money, but I allocated 100K to this, to build this covered call fund.
Yeah.
I'm basically at the end of that. So I actually don't have more allocation room to keep buying on the down dip.
Yeah.
That's why I'm more annoyed. I'm like, why did I buy 5K yesterday? I should have just waited till today.
Yeah.
I knew it was going to go down, but I'm just like, but sometimes I just want to buy stuff so I can forget about it and just move on to the next thing.
Yeah.
Right. Because like because I'm doing a lot of value investing research right now where I'm actually buying like select stocks for like long-term growth. I'm like, I can't keep thinking about this. I kind of want to just like set it for the winter and then check back at the end of New Year's.
Yep.
Yeah. And just get those dividends and figure out what to do with it. So that is actually the only thing bothering me. It's not actually the fact that it's negative $4,000. It's, I should have timed out my allocation a little bit better because I knew it was going to keep dropping. And I'm thinking it might go to like 11 cents. I mean, $11 or something around that, at $11. Like it might keep going down. Do you think it will, or do you think it's going to cap out
How many positions do you have?
in covered call?
Yeah.
Oh, not a whole lot. I have, let me check. Blossom. This is a
unlike you, I don't keep cash on the side. I don't have any money on the side.
Yeah.
But because I have so many ETFs, right? I get dividends on a weekly, monthly basis. I'm always just reinvesting those distributions. But you're right. Like that's one of the downsides is that all of a sudden there's a dip in the market and you want to buy so bad and you have to wait
Yeah.
4 more days until your distributions come in. And you watch,
Yeah.
MST will go up as soon as our distributions come in on the 8th or the 9th. And everybody
I
starts
know.
buying,
Yeah.
right?
Yeah.
So
Yeah.
just
Yeah.
as you want to
Yeah.
buy, all of a sudden it's going
Yeah.
to jump like $2 and you're going to be like, damn you.
That's what I mean. Like I know my distributions are all coming in, and I actually have here. Actually, I'm going to talk to you about this first, but let me go through what I have my holdings right now. I have HHIS, MSTE. This is all in non-registered, by the way. I only post on Blossom my non-registered account. I actually don't post my TFSA, my RSU, my corp stuff. Some stuff I just want to keep private. And I talked to my wife about it, and she's like, "Please don't show everyone our like." I was like, "Okay." Like it was actually my wife. If anyone blame my wife, I'm not gonna get mad at her. She's like, "There's something in Indian culture called nudger."
Yeah.
And it's basically the evil eye. And she's like, and she's basically like, oh, if that dollar amount goes public, it's like only bad things can happen to you. Right. And I was like, yeah, okay. But I still want some social proof. And I still want something I could sort of like work with people online. I'm like, well, how about my non-registered account? I'm getting taxed, and there you go. We'll use that. And then I only post stuff on Blossom that I publicly talk about that I own. That's right. And then I correlate them. But so here's what I publicly talk about: HHIS, MSTE, cash, which is the cash ETF. It's instead of just holding cash, I just have the cash ETF.
Yeah.
This isn't actually in my non-reg, but I have UNH, United Health. Okay. It's a value stock. I can talk a bit about that later. Why I bought it.
There's a stock that didn't drop from 600 down to under 300, right?
Yeah. It'll come back in all time.
Bought that at 600.
I know.
Right.
I know. Yep. But that's going to come back up. Well, I don't know. I can't guarantee, but it'll come back up in the next 3 to 4 years. So I just have it there. Yeah. And I have a video coming on next week.
Hopefully
explaining why I bought.
You bought it near the bottom?
Almost at the bottom, basically. Yeah. Really, really close. That's how I pick stocks.
Yeah.
USCL, that's a position I'm building into now. I'm excited about this one. Yep. MSTY, SDAY, QDAY, PLTE, NVHE, and then I have TQQ, which is in a covered call. And all the stuff I made public, I have small positions and everything else. The positions I'm building, though, actually is HHIS, MSTE, USCL, maybe HYLD, bank, and UTES. I probably will, and now I'm going to be using dividends from probably my HHIS position. I don't even know. I'm going to use dividends. I'm going to use the dividends to buy whichever one is dropping in value.
The most.
Yeah, that's it. So I don't even have a thing. It's like, if it looks like something's going down, I'm buying that one. And I'm not going to care too much about how it's weighted. If I'm overexposed in MST, but it keeps dropping, I'm probably going to keep buying it.
Did you mention SDAY or QDAY?
Yes, SDAY, QDAY. I don't have CDAY though.
Okay. Yeah. So I got rid of my USCL because I had a small position, and I got rid of my QQCL, another small position. But now I'm buying SDAY and QDAY. I like them a lot more.
Okay, before we move on to the second one, which is HHIS, let's talk about SDAY and QDAY. Let's focus on those two because I have a lot there. So I own SDAY, QDAY as well. I was considering building up those positions too. For anyone who doesn't know, they are, oh my God, I got shit on online. I kept saying, I kept saying bi-weekly, right? Or something. Yeah, it's I said but it's I kept saying every 2 weeks.
Yeah.
No, but it's twice a month.
Right.
I have to make that distinction. But it's just like my brain, I know what I'm trying to say, but my brain just kept saying that. So it's like, oh my God. And I'm like, yes, I get it. Like you get so many comments and you're just kind of like, yes, I get it. I'm hoping, do people not understand me? Yeah. So you're building those.
You're human, right? Just because you're on YouTube or something doesn't mean you don't make mistakes.
You know how much information we have to sort through before anything goes online. And then you're trying to project that information in a comprehensible way. It's like, and then I'm a guy who slurs, talks fast, mumbles. I get excited. It's like, to contain all that for 10 minutes and just tell you information, I'm going to say stuff wrong. Right? Sure. So QDAY, SDAY, let's just make these ETFs number 2 and 3. I got to keep track of this because we're going to be going through a lot today. So ETFs number 2 and 3 are QDAY and SDAY. Why do you like those?
Well, you're going to be surprised at this one, but because they have a higher distribution, right? They have a higher yield. You know what I mean? If you look at
Yeah.
QQCL and UCL, and then you look at those two, they're, I don't know, 2 or 3% or 4% higher. But I also like the fact that they hold a Hamilton ETF that doesn't have a covered call, right? So 100% of your investment is in an ETF with no covered call. And then there's the 25% leverage that they use to buy the covered call. So you're actually getting both. You're getting the best of both worlds, right? And you get paid, every twice a month, not every 2 months.
That's actually what sold me on it was when I figured out their fund structure. I was like, God, that's brilliant. I think they're selling covered calls on like VOO or something. That's what they're right. And you know who does the best at explaining it? God damn it, it can sound like I'm all over his balls when I'm talking about this, but it's Adriano because
he's the guy, right?
I actually would defer to him. Like I've been pretty transparent in my cover call experience. It's like I was getting into the beginning of the year. I kept having guests on talking about it. I'm like, hey, I really want to get into it. So I'm sort of like I'm actually fairly new in the space too. I can talk your ear off about value investing, like how I picked UNH. That's how I made all my money. But covered call, I'm sort of in the same boat of like I learned from guys like Adriano watching them. I'm doing tons of research on the side. But you're watching me sort of make mistakes on the fly here. Like that's kind of what it is. So like I do defer to him, and I find myself leaning more into his strategy over time, maybe to my own growth investment. I like the stability of like the USCL. Like, oh, it's just basically VFV. I love V. That's my favorite ETF. I'm like, great. I kind of, there's something about that I like. And then it makes me go like, in my brain, it makes me go like, hey, yeah, I built up VFE to a massive position. I want to build up USCL to this isn't some fly-by-night thing. I'm going to build this up. So when I'm 52, who knows how big this thing will be, right? Maybe I'll never use money for my TFSA or RSP. I'll just keep living off my my non-reg account, right? Like, who knows? It actually gets me, that's why I said I get excited about it. I go, ooh, wow, this is cool. Anytime I get excess income, maybe I'll just like dump it into that. Like, I can just keep doing that now. But with QDay and SDay, the fund structure, let's talk about that. They hold 80%, just like regular companies, and I think they get dividends out of them too. Whatever. I don't know the companies off the top of my head. But like I said, just watching Adriano video, he actually goes through all of it. But then they have 20% covered calls on VOO, and I'm like, that's good because I feel like that's low risks, but they're just churning out high yield. The yield off the top of my head, do not quote me, is like 18% or something. It's higher
than 20. So I think 18 for C day and S day, and then 20% for Q day. Of course, it depends on when you buy it, right? I'm trying to buy them under $24, but definitely no more than 25. 25 is the max I would buy them at.
So how are you going to be building up? Are you going to be putting emphasis on just like whenever they're below that number mark, load up on those?
Yeah, well, I think, yeah, exactly. Every month when I get my dividends in my RSP, I'm going to be buying S day and Q day. And then in my wife's portfolio, I'm selling off some of the stuff that we bought years ago, like LBS. I don't know if you know the split corps, but LBS and probably her canoe position, positions that she's done well. They're in the green and she's collected 2 or 3 years worth of distributions. We're getting rid of those. And I'm going to buy Q day and S day for her instead. And her monthly distributions are going to skyrocket. I'm actually excited.
How do you feel about the twice a month dividend payments? I feel like that's good for your lifestyle at this moment. Just getting that money coming in. You don't have to wait a month. You have these things in between in case you're like, I need some cash right now.
Yeah. Well, I like it. And also, as you said, when you have buying opportunities, right? The more often you have money coming in, the more often you can take advantage of those buying opportunities.
What are they? Do you even know what they're weighted at off the top of your head in your portfolio? What do you think you have in those?
Oh, right now I only have 200 shares of each, so they're pretty low. Yeah, they're pretty low for me because I just started buying them. But like I said, it's going to be consistent in my RSP. I'm going to keep buying them until I'd like to have probably more like 500 or 1,000 shares of each.
Something to note, you mentioned this is in your TFSA and RSP, and your book cost is $436,000. That's a lot of money, tax free. So like that's a different, like you got a lot, like you're working with, that's a good thing to be working with right now, which means I think that's some peace of mind there. And you have so many ETFs that you're so like diversified here where I guess all your eggs aren't in one basket, even though you are pretty heavy on MSTE and HHIS. Okay, so that's QDay. We like QDay because of the fund structure. We're both in agreement on that. It's producing high yields, but it has that stable foundation of just an underlying sort of bucket of dividend paying stocks. So that's good. I think I'll probably build that up with you a little bit. I'll probably do something similar to you because I haven't sold them. I wasn't going to sell them. I'm selling off a bunch of single stock tickers I have, but I was actually going to keep those two. I was just deciding what I was going to do with it. All right. Wait, what about C-Day?
Because I have Bank and Utes from Evolve, and I also own ENCL, I thought I probably have a good overlap of the Canadian stocks that are in, or the Canadian companies that are in C-Day. And I assumed that Q-Day and S-Day would have higher yields, but I think S-Day and C-Day are actually the same. But anyways, maybe at some point in time, maybe I'll add C-Day. I haven't yet.
Let's talk about, we'll get to HHIS again eventually, guys. But let's talk about, every time you say something, I'm like, let's talk about Bank. That's the one I'm thinking about buying. I've done a video on it, breaking it down. It just made sense.
Yeah.
The thing is, before we jump into it, the greed in me gets to me where I'm like, I want the higher yield. So whenever I go like that, so sometimes I'm not even thinking about adding stability or adding diversification. Like, oh, Bank is like filling a position I don't have, covering that part of the market. I'm going, it's taking away, it's lowering my overall yield. I just see it as that way. It's like taking away. I was thinking about this last night because this is what I think about why laying in bed is. Maybe I should have a benchmark overall yield, and try to keep that. Like, I feel like you have 30%. I feel like for me, I'm gonna write this down as I'm talking. 30% average yield maybe should be my benchmark if I can make that work. Right? Can I maintain stability, diversification? I think QDSD add some stability there because with their fund structure. Bank, just by what it's holding, adds that. Why do you own Bank? Tell me about that. And how much of your portfolio is it? Just off the top of your head.
Where's Bank? Give me a sec. I'll figure that out. But so as you said, you like Adriano's way of investing, and I started following him in 2020. If you saw his portfolio back in 2020, he had about 75 positions, where now I think he's got like 7, right? So he's changed a lot over the years. But anyways, when maybe a year ago, he interviewed the founder and CEO of Evolve, and I can't even think of his first name right now. But if you have a chance to go back and watch 1 or 2 interviews of the Evolve CEO, he just sounds very, very, very intelligent. And if you look at the ETFs that he's putting out, like Bank and Utes and Call and some of the other ones, they're so smooth. Like Bank goes a little bit up and a little bit down, but it doesn't fluctuate too much. And the distribution, since I've started buying it, I think they've gone from 9 cents to 10 to 11. So instead of cutting, they're going up. I think you are getting about a 16 or a 17% yield. So if you were holding something like HDIV or HDIF or HYLD, right, and you sold those to buy Bank, you're actually increasing your yield by about 5%. So yeah, I think Bank's great. You can't go wrong with it. Under $8, I like it the most to buy. Right now it's about $8.30, which that's how I hold cash. If something like Q-Day drops enough, I'll sell Bank and I'll buy Q-Day. And then when Bank goes back below $8, I'll buy more Bank. So that's kind of my cash account. Yeah.
Are you trading basically weekly at this point? Just making a little...
Well, I get dividends every week, so I buy every week. Yeah, I buy every week. Well, I'm addicted to it too, right? So
yeah, it is. It's hard not to, right?
Yeah, it's always just trying to grow my monthly income, and sadly, I do this about 5 days a week.
Yeah, that's the thing. I got to catch myself because you said addictive. I'm like, I find myself enjoying it sometimes, and I don't like mixing enjoyment with me making money. You know what I mean?
Well, and not, isn't it better to have a job or like,
I 100% agree with you.
Yeah.
I 100% agree with you. I just try to catch myself not making impulsive decisions.
Right.
So I'm sort of formulating as I go along. I have a very stringent rule list. If you people join my GG Wealth Academy, you can go on GaryGillX.com. I have a checklist I go through before I buy any stock.
Really?
Like I don't deviate. I stick to this thing. If it doesn't meet all this criteria, I just put it. It's in the thing. I have a resource section. You can just download it once you join.
Cool.
It's a free academy. Everyone is joining, right?
Yeah.
But I just and the checklist I gave there is actually more basic than what mine is even worse, like more thorough. But I figure it's a good way to stop people from making stupid investment decisions, so I put it in the group. But I don't quite have that checklist for covered calls. My strategy here yet. I'm building it. Going. But one of the things is what you said right now was, and this is my checklist for when I buy stock singles is if they're dividend stocks, has the dividend stayed the same or increased?
Right.
That's something I'm now applying to every single one I buy now. Has it stayed the same? Is it first or is it increased? Exception, MSTE. The only problem I have with this, it's hard to apply to covered call strategies because there's a new ETF coming out every goddamn week.
Yeah.
There's no historical performance. UNH, we just talked about that briefly. I know what their historical performance is because they've been around forever. I can just pull from 10 years of data and I can look at all that. There is so much, I guess, speculation here. I feel like even when I do the research, I'm like, I don't know, like Q day, S day. I guess it'll hold. I don't know. I actually don't know.
Yeah.
Like,
And
how does that factor into this?
So if you were a dividend growth investor, right? Let's say you wanted to buy things like Johnson and Johnson and you're 20 years old and you're going to hold it for 35 years. You want to buy something that's increased its dividend every year or twice a year for 20 years, 30 years, whatever, and you don't want to see dividend cuts. But as you've seen in Adriano's videos, fluctuating distributions with covered call ETFs is very normal, and it would actually be more irresponsible of them to not cut the distribution, right? Because we don't want them to pay us bad rock, right? We don't want them to pay us money that they're not making. So whatever they're earning in premiums, that's what we want to get. And I mean, when you're looking at something like MSTE, where you're getting a 45 or a 50% yield, and they cut the distribution, so now you're only getting a 35% yield. How do you complain about that? Like if it had launched with a 35% yield, you probably went like, oh, that's great, let's do it.
Yeah.
Right?
Yeah.
So yeah, I know it sucks when you see your monthly income lower a little bit, but I think it's just part of the way it works, and there's going to be good times and bad times.
I'm thinking on the fly here.
We hit a recession, there's going to be a bad time, but it's going to be a buying opportunity. So
what do you think about this rule? Because I'm just making up rules as I go, like just as I'm talking to you. What about when you have core positions, stability, like the closest you can get to stable? Well, yeah, Adrian would say they're all stable, but like USCL or HYLD or HDIV. HDIV is a good example of like stability, I feel. You could look at those with hey, do they have stable yields for the past, however long their history is, because you're looking at them for stability. But then when you get into the bucket of higher volatility, you throw that out the window. You go like MSD. I know. Maybe you just you separate the two depending on what role it has in your portfolio. You go, hey, USCL, HYLD, HDIV. Do things, whatever version of those I pick, they're the ones that have to be stable. So I need them to meet this criteria. But I'm picking MSTE. I know this is just a bomb. So like it could blow up at any moment or do something really good. I factor that in. What do you think about that decision-making process?
No, I agree with you. And I don't know if you've checked, but I think USCL did actually cut its distribution at one point. So it's not as
probably
stable as you think it is. But yeah, you're right. I mean, when you buy certain ETFs, you're buying that specific one for a reason, whether you feel like it's safer, or less likely to cut its distribution. Chances are it's a lower yield, maybe between 10 and 12% or up to 14%. See, the thing is, when you get one like MSTE that's paying you something crazy like 55 or 60-cent distribution, if it does that for a year, can you hear the dog barking or no?
Oh yeah.
If you do that, say you do that for 6 months or a year and you collect that amazing distribution for a year, now you've had, like for me, I'm getting about $1,500 a month. That's $1,500 a month that I can now put into, say, Q Day, right? And now Q Day is going to start paying me. if I had gone with something like HDIV, instead of $1,500 a month, maybe I'm making $700 a month. Now I can only buy $700 a month worth of Q-Day. And in a year from now, when MST cuts its distribution, well, it won't affect me because I don't own it, but I won't have as much Q-Day as I would have had owning MSTE. So
Yep.
do you see how that works? Like you're getting the higher distribution. While you're getting it, you're using that to buy other ETFs and building your portfolio. So
That was more or less my strategy that I was going to be working on. How much of your month, off the top of your head, like how much do you take out to reinvest? How much do you use to reinvest? How much do you to spend on stuff, lifestyle? Now that you're sort of no longer working, are you going to be spending more of that allocation on your lifestyle now, distributing less back into the ETFs? Because of that, are you going to be leaning more into less volatility and more of a sure thing? Like, where's your brain going with this right now?
Um, well, so what I was doing was just using the money in my cash account. So whatever money was producing my cash account, I was using that for different bills and things. Then back in June, I decided to start pulling $1,000 a month out of my tax-free savings account, and it was more or less to prove to the naysayers that you could sustain a covered call ETF
Um,
while pulling money out. Right, I have an RBC tax-free savings account with just over $50,000 in it, and at the beginning of the year, I was making about $850 a month in dividends. I switched it over to all these harvest, MSTE, HHIS, right, the Coinbase one, the Nvidia one, right. I got the dividends up to over $1,600 a month. So what I do now is I pull out $1,000 and I reinvest the 600. So now I'm taking the money from my non-registered account and from that account. But yeah, I'm going to have to look in the next few weeks to sort of see if I get any EI or other funds or whether or not I'm going to have to pull. But I think it'll probably be maybe $4,000 or $5,000 a month. I'd have to end up pulling out if I wasn't working. I really don't want to touch my RSP if possible. I want to pull the money
yeah.
out of my tax-free savings, my tax-free savings account. But then come January, what I want to do is I want to move the money from my RSP to my tax-free savings account, if that makes sense, right? So then
Yep.
build up the tax-free savings account again, use all the room that's been made over the course of the year. Um, and I think that's a strategy that I want to use. Well, first I'll move the money from my cash account, my non-registered. I'll put all of that in my TFSA because there's no point having
Yeah.
any money in a non-registered account.
Yep. Yep.
Yeah, that's kind of like the long-term plan. I haven't really figured it out 100% yet.
You should try to build case studies for all this on your YouTube account, so people can follow along with you and how you're doing this. This is such a good, everything you're doing is such a good case study
Yeah.
of like, okay, so this is how we manage it while you're figuring it out. Like, if you do that, I know I'd be watching it, like, oh, so how's he doing it? How's he doing it?
Yeah.
And then,
I
right? Because
started
it's,
I started back in May on Blossom doing a real life case study
yeah,
for the $1,000 a month. And then when I started my YouTube channel, that's what I did. I made it into a video.
case,
I think
yeah.
I've done 4 videos so far. So I'm looking forward to September. Well, it's September now, but for the next round of distributions. And yeah, it's great. I like doing it, and people like following along for sure.
Make sure you guys follow him on Blossom on YouTube. You're really active on Blossom, really active on YouTube. Everything we're talking about is on all both platforms for you. I have a feeling a lot of people watching this already know who you are. I just have an assumption that they probably know who you are, but just in case, and you saw his and the link to his social media handles are in the description of this video and the first pinned comment. So make sure you check those out. You can click through all his socials just on this video so you can get a hold of him. You kept saying, is it you? I call it UTES, but you call it UTs or something. What do you call it? UTs or something?
I call it Utes.
Utes. I call it
Call it
UTES.
Utes.
I call it UTES. What is the so every time you said it, I was thinking like, so that how you say it? Can I say UTES? And I have a lot of videos saying UTES.
Yeah, I don't know why I call it Utes.
Okay.
Let's make it one word. Well, you know what? I think the person. Okay, so yeah, I think the founder of Evolve, he said they named it after that movie. You know, the one movie where in court he calls them Utes.
Oh, really?
Yeah, he called them
Okay,
Utes.
Utes. I'm gonna keep saying Utes. You keep saying Utes. We'll see what the. Leave a comment below on how you think it's pronounced. Okay, let's talk about that. I'm gonna make that
That bank is 3% of my portfolio. It's not as
three
much as it
percent.
used to be, but right now it's 3%. And Utes or Utes is 5% of my portfolio.
Okay, let's talk about Utes. Move on to that. So for first off, bank. I don't know if you talked about this already, but same thing. If it hits a price target that you like, you're gonna buy more of it, like everything else. That's kind of the strategy, really. Every time you something, yeah, same
Yeah.
as me, I guess.
Yeah.
Yeah,
Well, and
yeah.
like
All
you
right.
said, I used to be very impulsive and sometimes I was just in a rush to buy certain ETFs. But I think
Yeah,
you're right. The better way to do it is to buy it when you're down. You know what I mean? To be
yeah,
averaging up in the long run doesn't make sense because
yeah,
they always seem to go down and then they go back up again. So why not buy them when they're down? You know, so I have to learn to be more patient.
yeah.
Yeah, I think I get a
I,
little too excited and hyper when I'm doing this sometimes. So
I think the two things that screwed up my patience was one, I had YouTube content coming out talking about this, so I needed something to talk about. I was like, shit, I need to report on this. And two, I wanted to just get a portfolio constructed and then start messing around with it. Like I just had too much money floating around. Like, and my brain's going, this is money I'm not getting distributions from. Like I just need to construct a portfolio,
yeah,
and then I can start messing. I can start selling, moving things around. And I just felt like I just wasn't there yet. So I
yeah,
felt like I could have waited. But personality wise, just let's just allocate this 100K, figure out where it's at, where it's not working. If I take a small short term loss, it's fine. I'm doing this for minimum 10, 20 years. I don't give a shit. I won't even remember this. So, like, but I was like, I just want to construct a portfolio and see where I feel about it.
yeah,
And now I'm starting to feel like, all right, I can stomach volatility. Oh, I am okay. I'm starting to see how I feel about everything.
yeah.
Um, and you could do that with as little as $1,000. You don't have to go mental like I did and do like you'll know how you feel pretty quick because I still feel shitty when I lose $1 or whatever. Like, you'll still know how you feel.
And the
So
thing is, you can use the exact same strategy on two different ETFs, and one time
yeah,
it'll work, and the next time it won't, right? Like I went
yeah,
heavy on Harvest's TSLY when it first came out, and it
yeah,
tanked, right? From like $12 down to 5 something. So I was thinking to myself, well, I did that all wrong. I should have bought slowly. But then on the other hand, PLTE, the first day it came out, I bought 100 shares at 12.90, and then it ended up at like 29 bucks a share. I should have
yeah,
bought a lot more on the first day. So either way you do it, you could be wrong, just depending on which
yeah.
way the share price goes. So it's hard
Let's
to,
move.
yeah,
Let's move on to ETF number 5, UTES, 5% of your portfolio. I like this one. I will start building into it. I think I'm going to build into USCL a little bit first before I move into this, unless it's
yeah.
like on a discount. I have to check the price. But what's your reasoning behind this one? You know,
Yeah, just utilities. I mean, it seems like something that we're never going to not need, right? So,
yeah,
and again, I think the distribution or the yield for this one is around the same as bank, 16, 17%. So it's pretty steady. I did buy it, I think, when it was a little bit up, almost close to $10 a share, and then it dropped down. Is it below 9? I guess below, maybe in the low 8s. Yeah, just again, it's Evolve. I really like Evolve. That's an important thing. I think you have to like the fund provider. So I think Evolve's a really good one. I would recommend anybody. Not financial advice, of course, but I think Evolve's a great company to look at. And
yeah.
again, utilities, it's boring, but they're not going anywhere, and it just pays. Every month it just pays. So
I want to talk to that Evolve team because what are they doing over there? They do seem like they have their shit together. Like there is like when I was looking, I'm like, they came up with bank and UTS. I'm like, that's like every indicator that I'm getting is like those are good products.
yeah,
So and I was like that I don't know why, but it just stuck out. Like I didn't feel like it was some weird cash grab scam. And I've been doing this for a long time. Like I'm like, this is real. This doesn't feel because some of that you see some, especially the US covered call ETFs, you're like, oh wow, this seems like a house of cards or something. But I was like, oh, this is like, oh, this is good. Like I wonder, like, is it just run by like this really, yeah, you were mentioning like this smart,
yeah.
young, smart people? I don't even know what it is. Like I gotta figure that. I honestly like I think that's gonna be a podcast episode for sure at one point. I'm gonna talk to somebody over there.
You should
But yeah,
try and get him on your channel. I know he worked for I think he worked for Wisdom Tree. some other ETF for a financial company. He worked for a few different companies, did really, really well. And then one day he just decided, I'm going to start my own ETF company. And people told him, well, it's already saturated. There's no demand in the market for it. And I guess he came up with the idea that if he could just, differentiate himself a little bit and make products that people want, and he has, and he's done well. Honestly, there's so many new ETFs coming out that I haven't really looked at Evolve in a while. So I can't
Yeah.
remember exactly what the difference is between them and say Hamilton or Harvest, but they're
Is
not
it?
they're not taking overly, like, some of the, you said American, right? Some of the American companies like I like YieldMax, I own YieldMax, but they are very risky. Where I think
It's
Evolve is a lot safer.
it's the brown guy. It's the CEO, Raj Lala. It's him, Raj Lala. That's the
Yeah,
CEO.
yeah,
Okay. I have been chatting with him a little bit back and forth.
yeah.
Yeah, I wasn't even aware. Yeah, it's the CEO. Okay, good. So, all right, cool. I'll probably have him or someone else on the podcast then. That's interesting.
And then
Yeah,
I don't
okay,
know if
I
you've
get it.
heard of it, but there's an American kind of like version of Evolve that's just started, Tap Alpha. Have you seen? I think his name is Sai Katera. Um,
Tap Alpha.
so their
Uh,
their first ETF was T Spy.
and what does that do?
So what he did, I don't know if you've heard his story at all, but him and his wife had a baby, and he was at home. I think he might have been unemployed at the time, but he was writing his own call options to pay their monthly bills, and it was taking him a couple hours a day, right, to write the options.
Uh,
But he's a computer engineer, right? He's not a financial guy. So he
yeah.
thought, well, okay, I can write a program that will do this for me. So he wrote a program that would write the calls in 5 minutes.
Oh, Jesus.
And then
Oh,
he thought, like, I'm 40 years old. Why don't I start a new company and create an
yeah.
ETF? Right. So I believe it's one of the zero DTE strategies,
Yeah.
but it's a 14%. Obviously, it's based on the S&P 500. That's why it's SPY. And as far as I've owned it, I've almost always had to average up because it doesn't usually go down.
Really?
Yeah, it's been so consistent. Some days it might go down a little bit, but it doesn't go below what I bought it at. So I'm always slightly averaging up.
Let's add that to the list. Let's add that to our list. So,
If you buy any American ETFs, I really like it. A lot of people talk about NEOS, SPY-I, QQQI. Those ones are great as well. I like this guy better.
okay, let's talk about. Okay, we'll UTS. We like it because it's utilities. We like it because the fund seems to be really good. And I'll talk to I'll talk to Raj over there and figure out what's going on with their team. Why are they doing a good? Why? It's a weird question. Like, hey, why are you guys doing a good job?
Yeah,
What's going
what are
on
you
here?
doing right?
Right?
Yeah.
Yeah. And then let's talk about T-Spy a little bit. I have some commentary on that. So his name is, CEO is called Sai Katara. So I guess you're just sending me every colored person you can think of here. Like, hey, do you know? Hey, the question is, we don't know. We don't all know each other. Just heads
Oh,
up.
okay.
So, yeah, I know. It seems like we do, but yeah, I'll reach out to him. I'll see what's going on with this guy too as well. So I guess I could use this as, because you said the price doesn't. It's a US ETF, so I guess I'd probably hold this in like my RRSP. Is that where you hold it, right?
Yeah,
Um,
I do.
I guess what would be the reason? My reason would be stability, I guess. I would use it as another core ETF, right?
Yeah. Yeah. I own, for example, ULTY, right? And for me, ULTY is like going to the casino, right? You got $500 in your pocket, you're going to the casino, and if you lose it, you lose it. You don't really care, right? Well, I don't go to the casino. I don't gamble that way. I gamble
Yeah.
on ETFs like ULTY. And I know that there's a chance I could lose a lot of money doing it, but that weekly payment is so attractive, right? But to balance off, ULTY, I have things like T-Spy, right? So the way I look at it is if you're building a house, right? If you're building a house, you want a really strong foundation, right? And then some other things might be just luxurious that you don't really need. So that's the way I balance it off.
What do you think the weighting is of T-Spy in your RSP or just your portfolio in general? Do you know?
I do know. Hold on a sec. I only have 500 shares right now, and I stopped buying it. It's just over 4%. So I have like 17,000 Canadian in it. Um,
That's sizable still.
yeah, it's pretty sizable. I wanted it to be in my top 10. And the only reason why I stopped buying it is because what Sai said was that once they hit 50 million in assets under management, they're going to come out with TDAC. So it's going to be the same thing, but on the NASDAQ. And it's coming out in September. So when that comes out in September, I'm going to start buying that one as well. And it should have probably, instead of 14%, maybe 15, 16% yield.
Why did he shouldn't have announced it? Because probably a lot of people said we're going to stop buying this other one. So like,
I think it's good to have both, right? I think it's good to have, like, whenever a company comes out with one on the SPY and one on the NASDAQ, you got to own both of them, right? You want to.
He shouldn't have said what he shouldn't have said when it hits. He just should have said, "We're releasing this one. You should own both." That's what it.
I think he wanted to feel as though his product was proven. You know what I mean, and that people actually were interested in it. And there's a demand for it, so he set that benchmark at 50 million.
When do you know when T-SPY was launched? How new is it? Do you know? Like, also, how long have you owned it at least?
Honestly, I think it's under a year. I think it's just
everything. That's and like the back to that original problem of a guy who kind of the growth investors like, I don't even know if any of these things will work. Like, am I relying on Sai to not run out of energy and keep managing this effectively and like make sure he keeps hiring the right people to make sure this thing doesn't fall apart? Like, I think about I think the management teams are. You got to really look at this. And that's why we go back to the other thing. We're like, hey, we have to go talk to Raj Lalla, the guy who's the CEO of these other companies. Like, what's going on with their management team? Like, that's essentially what you're sort of like betting on those guys and gals. Okay, let's talk, because you mentioned ULTY. Let's make that number 7 here, because I hear so much about this one. I think I don't even watch content on it because I don't own it. So I actually don't know too much about this because, like I said, I don't own it. I don't think I've even made one video about it. All I know is it's a US ETF that everybody talks about that has some insanely high yield that is super attractive, but super risky, super unproven. I'm assuming it's another one under a year. Fill in all the gaps in my knowledge. What actually is it? And I guess RRSP again, right?
Yes. Well, actually, I do own it in my RSP, but I also own it in my TFSA. I decided to buy a little bit of it in my TFSA. Like I think I sold some other funds that made a good profit and had some distribution. So I just added ULTY for that weekly payment. You're familiar with Jay from YieldMax, right? CEO or founder, whatever he is. Well, they came out, years ago, they came out with TSLY and OARC, their first two. And then since then, they've launched like 50 more single stock ETFs, right? Then they came out with their fund of funds, YieldMax and YMAG. So what they decided to do was put out this product called ULTY, which was like, everybody thought it was a utility fund, but it's not. It's like ultra premiums or something. So they decided we're going to find any stock that has the absolute highest volatility. We're going to buy those, hold them for a week or two, try to make as much premium as we can, and pay out this ridiculous distribution. But it was once a month. So they launched the fund at like $20, and their monthly distributions were incredible, but the stock price tanked. Like they were giving you $1, it would drop $1.50. Right? They were giving you another $1, it would drop another $1.50. So I was one of the suckers who got in early at $20 a share and watched it go all the way down to like $5. So, I mean, at that point, I was in so far, it was like, I'm just going to hold on to it and forget about it and pretend I don't even own it. And then this year, around April, I think it was April or May, they changed the prospectus. They decided that they would actually own the shares instead of trying to use like a synthetic strategy. So they own the shares. And they started adding holdings like Palantir, Coinbase, companies that people actually know and have heard of and that are volatile, but not as volatile, right? So all of a sudden the share price started going up and they switched to a weekly payment and they were consistent, like 10 cents a week payment, which worked out on a $6 stock. You're looking at like 80 or 90% yield. So people went absolutely nuts for ULTY and just people are buying like 1,000 shares at a time, 10,000 shares, whatever. And then in the last 3 weeks, what happened? It started going back down again, right? So it went from 630 down to 6, down to, I think it's at like 550 now. Now everybody's bashing ULTY. Now it's no good anymore. It's dropping faster than it's paying out. It's worthless. So it's it's like a roller coaster. It's fun to watch how emotional people get about it. As it's going up and paying well, they're all excited. As soon as it starts
Yeah.
going down a little bit, they're all freaking out.
So for Alti, they did attempt to add stability to it and to okay, I don't know why. The first thing when you started describing Alti is all I got from that was you seen the movie Wolf of Wall Street?
Yeah.
The other thing? Okay,
Yeah.
so I don't know why. All I got when you're talking was, oh, so I just had this very vivid thing in my brain while you're talking. I saw a bunch of people working at YieldMax who are managing Alti, just ripping massive lines of cocaine when they wash it, being like, "Woo, $1.50, yeah," and then and it's going mental, and it's like, "Let's make money," and then they come down from their crazy high. They decide to get clean and go, whoa, what did we just do? Okay, we got to actually like figure this out.
Yeah.
So as they're sobering up, they started putting together this new one. So
Yep.
all I see in my brain is a bunch of people doing that, and then they created Alti. So I think because of that, I'd stay away. But I get what you're saying. So you're saying high risk, high reward. Ignore my wolf. Sorry, you said J at YieldMax. I'm sure you guys aren't like this. I don't want to make people think that their company's full of drug addicts. But ULTY is high risk, high reward. Maybe best used when you're like, hey, I got a little bit of capital that I want to take. I don't know. Maybe it's not take some risk on. Have a little bit of fun. See what happens. I'm completely okay with taking a loss on this. Like just talking to yourself beforehand. But I'm completely okay with getting a huge return as well, right? Is that how you sort of view it? Is like one of those sort of things?
Yeah. And the other thing they did, I think I forgot to mention, was I think they started using some sort of protective put strategy. Again,
Oh yeah.
I've never written calls, sold calls. I don't really understand all of it that
Yeah.
complex. But yeah, they're using some kind of a protective put to try to minimize the downside, I guess is what they're doing, right? But yeah, for me, it's just, I'm so far into it now, like, because I already owned it since the time it was at $20, and then of course once it got down to $6, it's like, well, I could double my position for a fraction of the cost, so I might as well buy some more, and the weekly payment's good. So yeah,
If it for massive drops like that and you already own it, I know my personality. I'd be like, all right, it's at $6. I'd just end up buying it too. And I would just allocate to the high volatility portion of my portfolio. Maybe I go like, maybe I shouldn't let the percentage get too crazy in my portfolio.
right.
But I'd probably do that. You mentioned how they protect themselves. I get the only two strategies you can really, well, not the only two, but the two common ones are setting up puts, right, to protect the downside there. Also, the distributions are protection as well, right? High distributions plus having a put strategy in place will sort of buffer you on sort of that angle. So I feel like for the strategy they're trying to do, can you do it much better? Like they're dealing with volatility. Like what can other than their initial coke fueled launch where they're like doing all that, like once they are like, hey, wait a second, let's actually do this properly. I don't know. I feel like they're like the way you described it, like, yeah, what else are they supposed to do in that situation when they're trying to crank out that kind of yield?
Yeah, I think they're doing exactly what the fund is supposed to do is what they're doing. And if you make it 1% of your portfolio or 2 or 3 and you're okay with that, then you're fine. Some people who are buying, there's one guy on Blossom, I think he's up to about 15,000 shares. He buys daily. So I hope it works out well for him. I don't like to talk bad about anybody. I hope everybody's strategy works out for him. I would not be comfortable with that. I would be nervous. But I think as long as you
I'd be
keep it small, right? Small percentage of your portfolio, and you know that it's kind of like your fun money, right? You got to have some fun in investing, right? Can't be all serious. So
I think when you're looking at stuff like that, you have to try to understand that you might not be looking at the entire financial picture of that human being. So, like, maybe he's got other sources of income, other things where he can handle more volatility. Like I mentioned, I have a whole other portfolio that's long-term growth investing. It's like my stomaching for volatility is probably higher than a normal person for this portion because, just by the nature of how I'm set up, right? So you can't that's also why you can't even follow people on their trades. You shouldn't follow the trades. Like I shouldn't actually copy you ever. No one should copy me because like you're dialed in because like we're talking about you have a very unique circumstance and so do I. this only works for you, really.
Yeah.
Hopefully people just take nuggets from you and go, I think that'll apply to me. Like, oh yeah, I'm in my 50s too right now. I want to retire early. Okay, what's he up to? That's why I said the case study stuff, but you're already doing that. But like, it's why it's so useful to follow you, because there'll be aspects of your life and your situation that we can all apply. Like,
Right.
I'm gonna be like, I'll be stealing stuff from you after this conversation, applying it to my portfolio. 100%. There's no way I won't be able to be like, okay, you're doing that. Great. I like your rationale. I like your thinking, your reasoning. Um, so for Alti, that's that. Um, Personally, I feel like I have enough volatility in my portfolio at this moment. I'll probably still not get it, but I am interested to. I would like to talk to that management team as well, see what's going over there, because, uh, yeah, because like the more I think about this, it comes down to those teams. I want to know what they're all about at this point
Yeah.
now.
Yeah, and you know what? Hey, look, if your goal is to get to a 30% yield and you're just below that, you could always buy a little alti and it'll bring your yield up for sure.
Your margin, your highest, your the way to increase your margin of safety when buying any ETF or stock is your buy-in price.
Yeah.
Right? That is how I see it. I go like, I can get a shit stock, but if I get it low enough, it's fine.
Yeah.
Right? Or like, for the most part, unless it's like actual garbage. Like I can have a hyper volatile stock like Alti, but if I get it at $6, I don't know what the range is, but if I get it at the low end of that range,
Yeah.
whatever. Right? It's just making sure you time out the buy-in. And that goes for value stocks like I pick as well. That's why buy-in price is so important.
Yeah.
And obviously my strategy moving forward, your strategy right now is already that now. It's just like make sure we capture those proper buy-in prices. All right, so that's Alti. Thank you for that breakdown. And remember, guys, ignore the whole drug addiction thing I talked about. That was just me making. I don't want people getting mad at me.
We're just addicted to distributions.
Yeah, distribution.
The
There you
money
go.
coming in.
There you go. I don't know why that just image flashed in my head. I did watch the movie recently, so maybe that's why.
Yeah.
Okay, let's go to number 8, and this is actually a large portion of your portfolio. And we were all out of order here, but we're just kind of going with the flow here. HHIS Harvest Diversified High Income Shares ETF, monthly dividend $1,177, annual dividend $14,000, book cost $55,000, shares 4710. I'm going to check my book cost. I'm going to check how many I have of this as well. Distribution 25 cents, so current yield 24.32%, per portfolio weight 13.5%. Why do you have this? I'm pretty sure I know the answer why everyone has this, but why do you have this one?
Yeah, you know what? I really like the fund of funds because of the stability, right? Harvest came out with 15 different single stock ETFs. You know what they all are: your Amazons, your Googles, your Palantir, Tesla, and you could go through and buy each and every one of those, right, if you wanted to, or you could try to pick which ones you thought were the best. But I find like holding HHIS. And again, it's a 25% yield. It's not like it's a low yield. It's probably way above average that it should be. But yeah, for 25 cents for a $12 ETF, I don't think you can really go wrong. And let's say I decide I want to buy certain single stock ETFs, but I miss out on one that was really good that I should have bought, right? This way you kind of like even yourself out. And also we were talking about MSTE because they dropped their distribution. They did, and so did Eli Lilly, the LLHE one. I don't know if you ever bought that one, but they dropped their distribution as well. But there's 2 other ETFs, and I can't remember which they are, but there's 2 other ones that increased their distribution. So HHIS has the benefit of owning all of them, right? So they're getting the decrease on the one hand, but they're getting the increase on the other hand, so they can keep that 25 cents consistent. And yeah, I mean, if you could get 25% on your entire portfolio year after year, you'd be in great shape, right?
HHIS has been the one I've been trying to stay the most unbiased about. I'm not, like I said, I'm not just trying to like be like, oh, I love Harvest or whatever reason. I genuinely, I like this. It's probably the only ETF. I'm warming up the USCL now too as well. Like I kind of like that, but like HHIS is the only one I'm like, I dislike this. Like on none of my, I have these internal red flags. I go like, I see something wrong here, wrong here, wrong here, wrong. All I see is wrong. I'm like, oh, this is good. This
Yeah.
is real good. And I like that they're just shifting. They have their bucket of companies. I don't know how many off the top of my head, but they're just like, all right, cool. There's more volatility in Tesla. We're going to trade in there. There's more here. And they just kind of move between them.
Yeah.
And they're just shifting it now. And it's, MST is tied to Bitcoin when that drops. This isn't tied to any one specific company. So it's not like a QQCL where it's like, I think it's QQCL with all of the NASDAQ. This is like whatever, like 20 companies. So there's some diversification built into it, which is nice.
Yeah.
The only thing when I was doing research and I kind of like, I put together an HHIS sort of reviewish type video, and my review videos always lean on criticisms because I own them.
Yeah.
Right. So if I can't tear apart my own holdings, why am I going to even talk to you about it? Because like I said, when I buy something, I just look at all the negative.
Yeah.
And I go, am I comfortable with the negative? I don't think about the upside. I go, is it negative enough where I can buy it? And one of the things it didn't really occur to me until I was into research was it's Tesla, I think there's like Palantir, all these different companies. Like, oh, there's diversification. But you'll notice when the stocks crash, all those stocks crash in tangent with each other together every single time. None of them, maybe one might stay out, but they all, when one falls, they all go. So technically there's diversification, but I realize there's not. So, but I was still okay with it. I just have to say that in the video. I'll be like, just so you know, it's not actually diversification because historically when one goes down, they're all going down together. Like they're all going down. You're not really like saving yourself there, but I'm going to tell you what I have now for holdings. You don't realize MSTE and for HHIS, we're the exact same. We have our book costs are we both have like 40 something thousand in MSTE. Your book cost was 55,000 for HHIS. My total for HHIS is 54,636. Wow. We're the exact same.
Yeah.
I have
around?
No, I have 4,350. You got shares cheaper than I did. I have 4,350. I got my average cost is $11.94.
And you're gonna buy more?
Yeah, probably. Yeah, if it hasn't been going down.
5,000. I'd like to have 5,000 shares, and then once I get to there, I don't know if I'll stop or I'll just increase the number.
I'm net positive for it. I'm up $22,668. I'm up 5% on this. The only reason why I haven't been buying shares is because I'm making money off of it, which is weird. But like, it's like, oh, I don't want to buy if if it's increasing in price, I don't want to buy it. So, and that's the only reason. Yeah. For my buy-in price, at least it is. It's at $12.59 as of filming. I bought in at $11.94. Right.
Yeah,
so
I actually, I created a spreadsheet for HHIS because I haven't had it that long. And I wanted, because people always ask me, well, what's your total return? What's this? What's that? The problem is some of these ETFs I've had for so many years, and I've at times I've sold shares and then I've bought back, and I haven't tracked 2 years worth of distribution, so I don't know. So I decided to do it for this one, and right now I'm up $4,000 just in equity, and then $5,600 in distributions. So that's not bad. I'm up almost $10,000. So, I mean, I know it could go down, but if it goes down, I'm going to buy more. I'm waiting for it to go down, to be honest with you. I'd like to see it under $12. Yeah.
That would be fantastic. I'm going to share sort of how I'm using HHIS with you right now, and let's see what you think. So I have total whatever shares I told you there, but I actually, in my personal tax sheltered account, I mean, not tax sheltered, in my personal non-registered, so I'm pulling this up as I look. So, but I actually only own, in my non-registered, I own, give me a second here. Let's just keep talking. So this is, okay. So I have 1,816, book cost 21,803. I'm up $1,059 in my non-reg. The rest of those shares, the other 3,000 or whatever I said, are in my wife's. Now, and the reason why I did that and I separated it is because we pay taxes on all this stuff, right? First, right? Right. And it's not so much like my wife makes less money than me or anything like that. It's just I needed to separate them because I will never reinvest any of the dividends or any of the payouts she gets from what's in her non-reg. All that money accumulating will get dumped onto taxes at the end of the year.
Okay, smart.
And then whatever is left over from that will then get reinvested.
Nice.
And it'll rinse and repeat. Her non-reg account is set up purely, whatever's in there is to hold like a cash ETF. Like that cash ETF I had like 10 grand. It's not even in it's in hers.
Yeah.
And all the covered calls never get reinvested. They'll depreciate with NAV, but I really focus on buying low there because I want ones that don't depreciate. So she doesn't have MSTE. She doesn't have anything volatile. It's purely there as cash in an ETF or whatever other ETF that does that for a 5%. And then all dividends just sit there, accumulate money until I dump it on taxes. And the tax will be used for what we both get taxed on.
Yeah.
That's like an easy way to manage your taxes. It's just like you just separate it. And is it the most efficient? No, but it's the most peace of mind. I know that she's sitting on, I don't know how many tens of thousands of dollars of HHIS just collecting for the next 12 months. So for us, it won't be 12 months. It'll be.
Do you guys max out your RSP every year as well?
Everything's maxed out.
Yeah.
Our RSP,
lot, right?
RRSP and TFSA, obviously, yeah, we're going to be doing that. Everything's maxed out. Her account for, I guess I can just tell you the strategy here. Her account is TFSA is only growth ETFs, right? Like a VFV. I have a 3 ETF portfolio on my video. She more or less sticks to that. Her RSP is very simple too. I kind of appeal to her sensibilities. She's hyper conservative. Also, I have to manage all this, right? And I don't want to like go into her account and keep doing it. Whatever I set for her, I kind of want to forget about it.
Yeah.
But I have her TFSA majority 3 ETF portfolio, RSP, similar type of 3 ETF setup. I have small cash allocations in both that are just liquid cash still, but not as high as mine. Then we have our corp account, which is a lot of single stocks, some index funds, and a lot of liquid cash. Then my TFSA is, off the top of my head right now, I would say 35% VFV. Maybe 5% is in like other index fund ETFs, like international. The rest is in single stocks that I do as value buys, and they outperform. So my overall portfolio for growth investing, I'm up like 38% for this year. The S&P is up. S&P, if you didn't buy in the April crash, it's like you're up 1.3%. If you bought in the April crash, you're up 10%.
Yeah.
My portfolio, because I use a value investing strategy, and I've been doing it for so many years, I buy that. And then what I do is, I have a pool of cash, I'll just use an arbitrary number of 100K, but I have a 100K pool of cash I give myself every year. I go, I'm going to buy things with this, and I'm going to sell them within 1 to 5 year time frames, right? But I always keep that number at 100K. That is it ready? Yeah. Now, when I sell something goes over 100K, I use that excess to buy VFV or an index fund.
Yeah.
That's it. And I don't go over the 100K because that's what I'm comfortable with. You'll never see me put $1 million into like a bunch of stocks. I go like, no. And that is how I've been supercharging my index funds for years. It's because I value pick. I either hold them, like Meta was a value pick for me, and I haven't sold it. Or I've sold a little bit of it. I sold a little bit of it last year and this year, but for the most part, I have a huge position, but I bought it at like, when it was at 1/7 of the price it's at right now, even less than that, right? But that was a value pick years ago that I did. So like, and that is my strategy. Now I have covered call on top of it.
Yeah.
So that's actually all I do. And more of my content on the channel will be trying to show this strategy. But a key thing, I have a video coming out in the next week talking about this. That's why I talked about it. This will come out after that video probably. But the thing is, with picking stocks and sharing picks, I will never tell you what I bought and sold until like 2 weeks after the fact. So you can't track my trades. Because that's just a legal nightmare. Like, I did what Gary did, and then it's like, no. Don't do that. But that's actually, so that's the strategy. That's how I use each account. So with my wife, hyper conservative, her stuff is more set and forget it. I have cash sit there. When I find a good value pick where I just want to maximize it, I'll use some of the cash in those accounts from hers, do the same thing. But with mine, more available cash, I do that. More hands-on. So my accounts are growing a lot faster than hers, but she doesn't care because she likes the conservative approach. I like it because hers is like when you look at a foundational aspect of your portfolio, hers is the foundation.
Yeah.
And when you get into mine, it gets riskier and riskier. Yeah. And then sort of that's it. And then eventually
it works together.
Yeah. And then eventually I would say I would probably, because I'm just like, I'm done with ever working again by the time I'm 39, between 45 and 50. I'm going to probably, at this point, I'll have enough experience, I think, with covered calls, where I'll feel very comfortable. I'll probably convert 50% of my portfolio to a stable dividend and covered call strategy. So it's like dividends that's like maybe a little bit of XCI, little things like that. And then also covered call. And then the other 50, I'll just keep in all my growth. Like I won't sell any VFV. I won't do any of that. I'll probably stop doing my growth investing, value investing, and just dump it all in the covered calls and then just hang out and make YouTube videos all day.
Yeah.
Like that's like the problem. But that's the strategy. Like that is it. That's what I'm leaning into. And that's my 5-year plan is sort of to get all that set up.
Sounds like you're going to be set.
You know what really helps? Having a finance YouTube channel, because we have so much access to so much information. I don't think my plan could get this refined because I get so much criticism online. I hear so many different people's perspectives. You're learning all the time. Yeah. It's like I might come in as an expert in the position. You might come in with your experience, but God damn it, we do not know everything.
Oh, there's too many ETFs now. There's way too many, right? And
too many styles of investing.
Yeah, I'm sure there's great ones that I've completely missed out on, but I don't want to have a portfolio with 100 ETFs, where ETF is paying me, $100 a month or $10 a month or something.
Yeah, too hard.
To be more concentrated. Yeah.
Okay, so with HHIS, I went on a long tangent of how I use it, but I think for people, the reason why I went on that is because how I use it for to basically just make sure I don't get screwed in taxes at the end of the year.
Yeah.
That's how are you doing it? So like mine is very rough. It's like, I don't even have to track it. I just go like, I just have a lot of money. I don't reinvest. That goes on taxes. Are you tracking it all in a spreadsheet? Oh no, you don't care. You're TFSA, you're RSP. You could care less. Unless
taxes wise, I don't. But the other thing about HHIS that I forgot to mention, because if you look at, in a way, Harvest has kind of copied YieldMax, right? Like YieldMax first came out with all these single stock ETFs. And then Harvest did the same thing, but they do it, in my opinion, they do it better, right? Because they actually own the underlying stocks and they only write up to something like 50%.
25.
Well, and they have 25% leverage, right? So they're doing it better. Now, YieldMax came out with YieldMax, which holds all of their single stock ETFs. The problem is some of their single stock ETFs are terrible, like they're atrocious, and people are begging them to kick them out, but they don't do it. They just keep it all in there. So, but with HHIS, they've capped it at 15 stocks. And now they've created some new ones, like they have Shopify. Shopify will probably replace one of the ones in HHIS that doesn't do as well. So we're going to get a bump in the yield, right? They're going to end up making more money. And as time goes on, they're just going to keep doing that. They might increase it from 15 to 20 somewhere down the road, but they're not just automatically putting everything into it, which is great. For me, I have HHIS in my RSP, and I have it in 2 different TFSA accounts. And basically, it's just generating income that I can use to buy other ETFs until it drops. Once it drops, I'm going to buy more. I'm going to try and be patient on this one, Gary. I'm going to try and be patient. I'm going to wait. I'd love to see it around $11. That'd be great.
Holy moly, yeah.
Yeah.
I would sell off stuff to make, actually, no, I just probably dump more money just I have laying around and into buying it, because I'm right on board with you. I'm waiting for that price to drop. It will drop eventually. Everything drops eventually, and then to load up on more. It is my favorite. It's my favorite cover call ETF right now off that list I gave you. You mentioned something that I was thinking about while we're talking. I was like, yeah, Harvest just copies YieldMax. Especially when I started, YieldMax goes, we have TSLY. Harvest goes, we have TSLY.to. We have MST. We have MST.to or .ne or whatever. That's all that they just wait for YieldMax to do something. Basically, here's my brain. I feel like Harvest is YieldMax without the drug addiction.
Yeah.
Right. They basically just go like, oh, because YieldMax would be like, we're gonna break covered calls with 100% of this fund. We're gonna 125% leverage this bad boy. Woo! And the Harvest is like, all right, I see what you're doing here.
Yeah.
Let's just do 50%.
And where you're failing, right?
Yeah. Let's do 50%. Right, so we can capture some upside, so these things will completely erode. And let's say 25%. I think there's some new ones out with 33%. This is not Harvest, but there's some other funds with 33% in Canada. Yeah. It's like, let's just do 25% leverage, so we don't like add too much volatility, and we don't, the downside doesn't hit us too hard. Oh yeah, that makes more sense. It's like more conservative, still good yields we're getting. It's just like, it's a very, I don't even know. It's a very Canadian way of doing stuff. It's like bringing rational thinking to like an uber American thing. It's like America's like, yeah, kind of like, all right, we got you. Let's just do this properly for a second here. Yeah.
It's the way, it's the Canadian way, like you said, right? It's even like our banking system, when their whole banking system
Yes.
crashed in
Yes.
2008 and ours was okay, right? So it's
Yeah.
just, you might not get those crazy yields, but at the same time, you're not getting the crazy drops, you get more
But
consistency.
But I feel like YieldMax is the idea guy and the trial by fire. They let YieldMax think up the idea, make all the mistakes, do all that market research, and then you go, "That's the one that works. Now we'll take it." Like that's all they're doing. Like,
Isn't that what Apple's done for years? Where Apple's let
yeah,
their companies kind of like create something, but then
yeah,
they perfect it and then they launch
yeah.
it and make more money.
But I think with Harvest, if they ever go like, "Oh, we got this genius product, we're smart," it's like, no, I know what you did here. You just waited, like YieldMax screw up a bunch, and then just refined their product. That's all you did, which I'm happy for.
Yeah, I love
It's
it.
fantastic.
I love it. Yeah.
All the benefit goes to.
Are you coming to the Blossom event in Toronto?
Oh, I'm in Vancouver.
Yeah,
Are you in Toronto?
I am. Yeah.
Yeah, I'm pretty bummed. I wasn't tracking. They went on this world tour thing, right, where they're all over the place. I didn't know that they were coming to Vancouver because I wasn't paying attention. I got two kids, 3 and a 2-year-old. So when I'm not doing this, I'm trying to keep up with these children. So like I have no idea what's actually happening as far as events go. So I missed the Vancouver event that just happened. So like yeah, I got 2 young kids. So like whenever I'm not working or doing YouTube, it's like I'm watching like Miss Rachel and Coco Melon on TV. I'm almost never on my phone, never on social media, all that. So and I'm not as ingrained in the Blossom community. Like I actually don't really know what's going on there that much. So like I just completely missed it. I actually didn't see it until I think he's the CEO, Maxwell, the CEO of
Yes.
yeah, yeah, okay. I have him on like just like we're friends on like LinkedIn and stuff, and I think he made a post about it. And I was like, oh damn it. Because if I knew that, I would have bought a ticket, would have showed up, would have been fun. Yeah, that's a bummer. So after I saw that, I meant, damn it, I need to make I don't know, I got to do something to keep my eye on like what's happening in the community in general.
Yeah.
Because, do you have kids?
I do, but I have a 20-year-old and a 23-year-old. So,
Okay, but you know what it's like when they're young, when they're under 3 years old.
Oh yeah, I bet.
I'm in that. I'm in that mode right now. So it's so like easy to be like, wait, what's going on, right? Because you just. My son just turned 2. My daughter's 3.5.
Oh wow.
So
okay.
yeah,
You started a little bit late.
Really late, man. I'm 39, so I guess what was like 36 or something when I had my daughter, and then whatever.
Yeah.
But my dad didn't have me till he was 42. So yeah, and as an Indian guy, that's weird. That's very Indian immigrant. That's very weird. But he was in the Air Force, so he has an excuse. So he had to finish his Air Force run and do all that, and then he had to immigrate to Canada. So he was later on in life. So he has an out. But yeah, so that's that. So HHIS. I don't know. Where does it fit in your portfolio? Like how much you like it? I said I like it the most out of all my ETFs. Is it sort of a similar sentiment for you?
Yeah, well, I mean, it's my largest position, so by design, it's my favorite. The only thing is that I get more money from MSTE even though it's a smaller position, it pays better.
Yeah, I know.
So can't complain about that, right? It's my highest payer, so I got my highest payer and my largest position. So I guess between the two of them, they're my top 2 favorites.
I built up that MST position so much in the last 4 weeks. And I won't be capturing all of that in this next run, but in October 9th, when they do that second round, because I'll be getting it all accumulated. That's going to be a weird feeling. Like it's going to be hard to control the greed in my bone, because you're going to be like, ooh, money, because your brain sees free money. It's not technically, right? It's an investment. It's something, but it's like that's something hard not to get excited. I mentioned before, I feel like excitement for me leads to bad decisions. Let's just talk about psychology wise, how do you control that aspect of yourself? When you see that money come in, are you pragmatic, being like, we're both adults, we both have bills. Do you just kind of go like, all right, cool, allocation time. The horses have blinders on so they can see straight. Yeah. Do you have your blinders and you see straight?
So I did because I did my first portfolio reveal video, and as part of the video, I broke down all the different accounts that I have, and then for each account, I made a goal for September, or I picked like an ETF that I'm going to purchase in September with the funds from that account. So I mean, could I make a change to that? Yeah, I guess if something on a whim catches my eye or something better comes along. But like for example, the new 9 points. Have you heard now? There's 9 points. They have
I
their they have so we have 10 more, so what Harvest copied YieldMax and now 9 points has copied Harvest, right? But so actually I shot a video this morning I'm going to put out probably later today about the Harvest Shopify versus the 9 points Shopify because they're basically launching the exact same thing, but there's some slight differences. So yeah, but I do have a strategy. I do. And so instead of just buying, for example, buying more MSTE, in each one of my accounts, I have something different that I want to buy. So at most I would buy MST in maybe one of my accounts, but not in all of them. So I do have a strategy for September for sure.
What brokerage you use? I use RBC for like the accounts I don't trade in that much. So like TFSA, stuff like that. I just like having it there, like tied directly into my bank. I don't
Yeah.
like that. But then for brokerages, do you use any at all, or are you just all with your bank?
Well, so in March of 2020 or February of 2020, I was with Investors Group. So all my investments were with Investors Group, all in mutual funds.
Wow.
As far as I'm concerned, probably not making any money. I think I
Mm.
lost out on, from what is it, 2008 to like 2018, that 10-year bull run. I wasted
Yeah.
it being in mutual funds. So when the market crashed in 2020, I started pulling all my money out of mutual funds and I opened up an account with RBC. Started going online and watching YouTube videos and I found out about Wealthsimple. As soon as I found out about Wealthsimple, I opened an account with
Yeah.
Wealthsimple. And I mean, Wealthsimple in 2020 was great for the no fees, but it seems like every 3 to 6 months they add something to the platform. And now the platform is like supercharged compared to what it was back then. So yeah, I
Yeah.
love Wealthsimple. It's great.
Yeah, I don't really have criticism about Wealthsimple as well. They were actually God, I just remember I used to use it as like a research tool sometimes, like just
Yeah.
like going through like I just remember doing that all the time, sitting on my phone and doing that with while Simple's good. I think like Questrade's good. I had a sponsorship thing with Moo in August. I did some stuff with them. It really just comes down to like what do you prefer, but I feel like Well Simple, if you're just starting out, Jesus Christ, did they make it easy?
They do. And
They
and
make it,
honestly, like sometimes people ask me questions and I can go on Wealthsimple right now and in 3 seconds, I can tell you exactly how much I've deposited, right? Like how much I've put into Wealthsimple and then how much I've made. Go on RBC, it shows you nothing. It
yeah,
shows you, just
yeah,
whatever stock you own and how much it's currently
yeah,
worth. But
yeah,
yeah, it's not the same at all, I find anyways. Yeah, the
yeah,
analytics, the
yeah.
statistics and Wealthsimple. Yeah, and it's getting, like I said, it's getting better all the time. They keep adding stuff. I don't know if you've noticed, but now if you sell, like if I decide to sell 100 shares of MSTE, as part of the sale, it tells you if you made or lost money and how much you made or lost.
Yeah, that's
I think it's
awesome.
pretty cool,
Yeah.
right?
Yeah.
Yeah.
So I think with you, for any new investors, I would probably lean everyone into Wealthsimple as well. I just feel
Yeah.
like it's so easy, it's intuitive, it's good. Um, let's talk about more of your ETF. So we've gone through so far because you have so many. We're just freeballing this. This is recap though. MSTE, QDay, SDay, Bank, UTES, T-SPY, ULTY, HHIS. Do you have any other sort of bucket ETFs left, or are you into single stock, stock
Oh,
ETFs?
bucket ones. I own QDTE, so I guess that's the Nasdaq, right?
Yeah.
I have HYLD, which is also a
Oh,
fund of funds. I know you mentioned
let's talk.
HYLD.
Let's talk about HYLD. I'll put that as number 9 here. Okay, so I don't own it yet. Here. Backstory really quickly, guys. I'm not gonna talk too much. I sometimes I ramble too much on these, but HYLD used to own originally, sold it. Um, I had a Hamilton portfolio. I had HYLD, UMAX, and I think HMAX. That was like
Right.
my intro
Yeah.
into this world. I think that's like the
I
most
remember
stable
watching
intro.
those videos. I remember when you were talking about
Yeah,
those ones.
Yeah, but that like that was like kind of like slowly getting, but then you know, then I just went crazy with it. I'm like, it's addictive thing. You're like, oh, couldn't you learn more? You get excited. So then I sold off HYLD because I was like, this is too conservative for me. And then I realized, wait a second, I need more conservative in my portfolio, right? So I'm actually now thinking about rebuying it.
Yeah.
And bring it back in my portfolio and having it be the yin and yang steel. Literally the thing I stole from Adriano, which is USCL, HYLD working together. It kind of, and so like they would probably have equal weighting in my portfolio eventually. Everything, those are ones that I'm always just building. Like they just build. So I'm not worried about NAV erosion so much because I'm always just buying shares.
Yeah.
Right. And I'm just copying his strategy. Everyone watching this probably knows his strategy. I'm copying his HYLD strategy of probably keeping it at HYLD, USCL, 30% of my covered call portfolio around there, maybe 25. And that's it. That is like what I do. How much of your portfolio is HYLD? How do you use it in your portfolio? I know you'll probably buy it if it decreases in dips and stuff like that. But like, you know, what's your reasoning behind this one?
So right now it's about 3.6% of my portfolio. I bought HYLD when it first launched. So I can't remember now if it was $15 or $16 a share, but I bought it when it first launched. And then for whatever reason, the market crashed. I don't know if that was 2022 where we had a bit of a bad year, but of course the market crashed. And then all the non-covered call people, you know, were pointing and saying, look, see how it's failing. You're losing so much money. I think it went down to about $10, right? It went as low as $10. And that's back when all of the holdings were US ETFs. Like they had a lot of other JEPQ or JEPB or whatever, that type of stuff, right? So, but when it dropped down to that price, I had to buy more, right? I had to bring my cost down. So I just kept buying more and more and more. Eventually, it was my largest position. It was HHIS, right? Before HHIS, it was my largest position. I think I had 5,000 or 6,000 shares. There's another friend of mine who watches Adriano videos as well. And we met on Facebook and we talk he's an old retired guy, but we were competing. You know, he'd buy 4,000 HYLD, I'd buy 4,500, and then he'd buy more. And we just kept buying and buying and buying. As soon as they cut their distribution, I thought, do I really want to have this much money tied up into one ETF where if they cut the distribution, it will affect my monthly income so much? So
yeah,
I think right around when I broke even share price wise, I started selling it off and just buying other stuff. At the time, it was, I don't know if you've heard of ENCL, but I started buying ENCL when it was on a dip and it was averaging about a 21% yield. So I started moving money from HYLD to ENCL. ENCL is Global X and it's oil and pipelines.
Okay, I was just about to ask all about.
Yeah. So and now HYLD, that it's all in-house, right? It's all the Hamilton, like you said, UMax or SMax. I don't even know all exactly what's inside of it off by heart, but now that it's all Hamilton, and I don't know if you've noticed, but the distributions just keep increasing little by little, like very, very small, but I think it's at 14.7 now cents. So right now I have 1,000 shares. I was at about 1,300 shares, but then of course Q Day came along or S Day, one of the two. So I ended up selling like 300 shares just to get into those. But I think I'm going to keep it at minimum 1,000 shares. And like you said, if it ever drops below my cost, I'll buy more.
Yeah, below your cost. Yeah, that's the strategy. You mentioned something where, HYLD used to hold a bunch of other funds within it. It wasn't holding all the stuff in-house. It started performing better when they basically cleaned house. When they kept everything in-house, they just cleaned it all up and then they control everything. That's when the turnaround, I think, happened, right? Where it just started getting better. And I know the price is sort of like whatever, but you said the distributions are increasing, which is that's what matters, right?
Yeah.
That's interesting.
They seem to manage it very well. And I think they hold back something like 1%. So they don't pay out fully, what they could pay out. But then I guess if they have bad months or something, then they can kind of like
wiggle room.
Yeah, they have wiggle room, right?
That's good. I like that.
As much as consistency as you can get with these funds is great. And it's always nice to see your position is green. Like if you paid $13 and it's at $13.50, So you feel like, oh, you're not losing money. There's no NAV erosion. But at the same time, I've got 3 years worth of distributions. So, that always, I mean, you do feel better about your positions when they are in the green. Although on the other hand, we always want them to go below our cost so that we can buy more. So it's,
Yeah. I think that's a balancing act there because my brain's adjusting to this. It's getting okay with the red.
yeah,
Maybe just make sure that red isn't too steep though.
yeah.
It's like, I think go from like $20 to $6, I think with the other one you mentioned, but,
Well,
yeah, making sure.
if you look at all my positions, Gary, like one by one, you probably find, I don't know how many, 5, 10, 15 positions that are in the red, right? You would look at them and they're all in the red and you would think, wow, you're just losing money. Like your portfolio
Yeah, yeah.
sucks. You are losing money. But like, as I look on Wealthsimple, my all time, I'm up 82%. And I think for somebody who holds covered call ETFs, I'm okay with 82%. That's good enough for me. Um, so I'm up.
And remember, you're not paying.
I'm up $150,000. When I started, I wrote this down to just in case you asked, but back in February of 2020, when I switched from mutual funds to managing my own portfolio, I had 131,000. That was my net worth, 131,000. And now I'm up 150,000. So,
When was this? When was this?
that was in February of 2020. I moved
Good job.
so I moved 130,000 over to RBC and Wealthsimple. And yeah, now my portfolio is worth a little over 400,000. So that's why when people say all you do is lose money, I don't understand it.
I feel like that point maybe isn't articulated properly. You have to think of a one sentence way of saying that because that's always, I go like, when people like shit on cover call ETFs, I go, but do they not know that your distribution, you got to equate that into your overall profit? It's like, why does everyone ignore that on the
The total
criticisms?
return.
Yeah. And then I think it's just hard for growth investors because like I'm coming from there to like, do that correlation.
Yeah.
And it's hard for growth investors, and I mentioned before, to accept that some people do want to enjoy their money today
Yeah.
and not just before they die.
Yeah.
And right now I'm trying to find the balance. Can I have both? What's that saying? Can you have your cake and eat it too or something, whatever?
Be a hybrid investor, right?
That's what I am, I think, at this point.
Why can't you invest in both? That's like
I
saying
think
you
I'm
can't
trying.
own rental properties and stocks at the same time. Of course you can.
Yeah.
You can own them all,
I
right?
think I think my goal is to get to like because right now the split isn't that even, but to get to like 10% of my portfolio covered calls, 90% what I'm currently doing,
Yeah.
and then slowly that percentage starts
Shift.
shifting.
Yeah.
Yeah. But then can I make that shift without selling anything ever? It's just, you know what I mean? Like it just shifts. I just start investing more into one area than the other area, but I never actually sold anything. It's as money comes in, I'm just allocating it differently. I wonder if I could do that. Like there's things like that I could do.
Your growth position is so large that you probably have to sell some of it in order to increase your covered call position.
That's why I know, like, I don't know if I'll ever actually be able to get there, like, with that strategy, but it's something to aim for.
You could probably retire tomorrow if you sold your growth position and put in
Yeah.
covered call ETFs, right? So,
Yep,
and one guy
100%
sent me a
easily.
message on Blossom. He said, I have $2.5 million and, could you help me put together a portfolio to retire? He goes, because I was thinking about waiting until I have $10 million and then put it all into SCHD. But he's like, I started watching your videos and Adriano's videos, and now I'm realizing that 2.5 million, maybe I can retire.
Yeah. Yeah.
And here I am,
I thought
$400,000 going, I wish I had 2.5 million.
you got a lot. You're doing just fine. You're doing just fine. A lot of people would be very, very happy to be in your position. I think my rationale for it is because I'm 39. I got 2 kids. My office here is in the basement of my house. I'm not going into work every day. I'm not missing time with my kids.
Yeah.
And everything I currently do, for the most part, the stuff you hate, is more or less stuff I like doing.
Yeah.
That I'm just like, if I retired, I'm doing exactly what I'm still talking to you today.
Yeah.
If I'm retired, it actually doesn't change anything. Like I'm still just talking to you. I'm still just going upstairs, hanging out. Like what am I gonna do with a 2-year-old and a 3-year-old? I'm stuck at home.
Yeah.
I can only do so much. So right now, it actually makes no sense for me to. I'm retired right now. My brain, I'm retired. I'm just doing a bunch of stuff I like doing, and so there's no point in me converting the growth portfolio because like I don't need it. right
Yeah,
now.
yeah.
So might as well just, and I
Keep it going.
understand it more. Just keep it going because I understand it. So it's more like a guaranteed thing for me. So I'm like, I'll just do this instead. So it's just that one reason why. But then as my kids get older and they don't want to be around me as much and they don't need me as much, and then I actually want to get out and do more stuff, that's when the transition happens. It's like I don't want to just be, but I think if I was going to an office every single day and doing all that stuff, that would have been I would have converted a lot of it and just been like, I'm done with this. I don't want to do that. I don't want to do the drive. Yeah. So it's just my circumstances don't really give me the motivation to like, I wouldn't, my life wouldn't change. That's what I'm saying. Like nothing changes
Yeah.
if I retired or not retired at this moment. Um, you mentioned QDTE. You said NASDAQ. Do you know roughly what portion of your portfolio that is?
Give me one sec. I'll let you know. QDTE, it's just over 3.5%. You notice a lot of my positions are around like 3.5, 4%, that type. I do have some
Yeah.
smaller ones, but yeah. So
It's misleading though, but 3% in your portfolio is like, that's $17,000. That's
yeah,
still,
it's still,
it's not something. Yeah.
yeah, it's something for sure. Yeah.
Um, do you, because you mentioned you have like 30, are you ever gonna bring this in a bit, lower the amount of positions you have, make it easier to manage, and just kind of have a maybe like 10 positions or something? Or do you like this method that you're doing it?
You know what? I have a lot of people comment on my videos saying that I have way too many positions. It's too much to manage, that sort of thing. And honestly, Gary, I've tried. I've been trying to eliminate ETFs that I think are not performing as well, not paying as well, or whatever the reason is. But the problem is I sell out of one, right? Like I got rid of RDTE because I bought it last year on my birthday and it didn't do as well as I thought, as I got tired of it and I got rid of it. But then, S Day and Q Day comes out. So you sell one, you buy two more, right? And then,
Yeah.
HHIS came out and then MSTE came out. So as much as I'm trying to sell off positions, and yeah, it'd be great to have a portfolio with say 10 and each one's paying me 1,500 a month and I'm making 15,000 a month and I don't have to worry about it anymore, would be great. But yeah, they just keep out coming out with new and better ones. So
I also think simplifying portfolio works for it applies in a couple scenarios. It's when people don't have the time or mainly the energy to manage their portfolio. It's like you're just going to start making mistakes. But like you mentioned, you're sort of in the same bucket as me. Like
yeah,
I kind of like doing this.
yeah,
Like I'm afraid of how much I like doing it. That's why I'm like, oh, I got to watch myself. And you're looking at it every day. You're selling weekly. It's like you're not overwhelmed.
yeah,
You're not, you're like, this is like fine. This is fine. Like, so why do you care? It's, there does become a level where when you have so much, the diversity doesn't actually add anything but volatility. But because of ETFs or new products are coming out all the time, I don't think that really applies in this
yeah,
scenario where it's kind of like, no, you're just sort of upgrading. You're working in these 3% increments, which means you're not betting the whole house on these.
yeah.
Right, like you have your core position, you have 11% in some, you have 10%, but when you're getting to these other positions, 3%, you hold it for a few months and you're liking it and the price drops, yeah, maybe you'll start slowly increasing. Like you're starting with pretty, like you're not overextending yourself into these positions, is I guess is what I'm trying to say. So, I don't know. I think you're doing just fine. It'd be different if you're like, oh, I don't know what's going on. This is chaotic. I can't manage this, but it doesn't seem like that's the issue.
Yeah, no, you're right. Especially since like in 2020, when I decided to manage my own portfolio, I basically turned this into a 7 day a week hobby. I really don't take days off. I used to
Yeah,
have an hour and a half commute to work. So in an hour and a half, I could either listen to music or I can watch, your video and I can watch Adrian's video and I can watch, 4 or 5 other YouTubers. And in that 1 hour and a half, I can learn about so many different ETFs, what's new, what's doing well, what's not doing well. So yeah, so I definitely keep up on it. Probably more than I should, but like you said, it's something that we enjoy doing. I have friends that I've gotten into this kind of investing and I'll ask them, oh, did you check out MSTE today? And they'll say, oh, I didn't even look at Simple. And I'm thinking to myself, I've looked at Simple 200 times today and you haven't even
yeah,
looked at it once. But you know what? Good for
yeah.
them. Like they set it and forget it. They wait till they get their distributions and once a month they take a look at what's low and, they make their buys and then they don't worry about it again. So,
I'm gonna talk about the psychology of all this because we both enjoy doing it. And when you enjoy doing something, you typically succeed at it way more than when you hate doing something. It's just because you're just doing it. You're not looking at the clock.
Yeah.
And I have to say, and not to ask myself, am I being obsessive or do I enjoy doing this? I realize I just enjoy doing it. And this is called a tangent warning for the viewers. Gary's going to go off on a bit of a tangent. So I'm going to start warning people before I do this.
Get a cup of coffee, get a drink,
best
snack.
Honestly, that's exactly what it is. So because I realize I have to start doing this now because I can't help myself. A year ago, no, less than a year ago, come around New Year's, I'm like, I need to start gamifying my life. In order to succeed in life, I need to, because I love playing video games growing up. And I like playing fantasy games. In these games, what are you doing? I play online fantasy games, so you play with other people, like World of Warcraft. And in these games, I was always doing really good. I would get my guy to level 60, make him the biggest, strongest guy. And then I'd always have a lot of money in the games because I'd be trading on the auction houses. I'd be watching for the best deal. I'm like, wait a second. I'm doing this in a video game effectively. I'm getting what I need. Like, it's fun for me. Yeah. So I haven't played video games since. I play them casually now if I want to go raid a dungeon or do something I can't get in real life. But for the most part, I don't. I'm like, everything that made me successful in video games can actually make me successful in life. I was doing it, but I wasn't correlating the gamification part aspect. I'm like, okay, great. I realized I loved the stock market, right? And a big part of me starting YouTube was because I was always explaining it to my friends, trying to get them to invest. And then I was like, I'm going to make this, and my advertising, by the way, is in capital markets. So I'm entrenched in this, right? But I was like, but I need to make this more of a focal point in my life than more than just advertising. I'm going to start educating. I'm going to start really just making this my gamification. I'm gamifying income creation because that's what I do in life. And I've done that. And then, that's why I have over 30% returns in my portfolio year over year. It's because of that. But then I took it a step further. I'm like, well, I like getting my characters to level 60. All right. So now I'm gamifying my health. Yeah. So what I do is I'm sort of, I more or less keep like a sheet where I track all those statistics now. Like I'm a video game character going like, hey, what's my strength level? What's my health? Like literally I'm tracking like, oh, my character is getting stronger. His bank account's getting bigger. And I've gamified my entire life. Outside of like the love aspect of my family and friends and stuff, but for health and for income, I gamify, and now I'm having fun now watching that progress, and my character gets stronger and wealthier over time because I'm just doing the same stuff I did in the video game. What do you think about that? I kind of just had this revelation, and that's a research. Other people seem to be doing this too. Like a lot of people are cluing into this. Do you think you've gamified it without even knowing the wealth creation aspect of your life?
Yeah, I guess so. I mean, I haven't really played video games since I was really, really young, and they were pretty boring, like in television games or Atari or whatever. But yeah, I guess in a way, and I like the way you're associating building up your character to a certain strength or a certain level.
Yeah,
that's what I focus on is the monthly income, right? How much did I make last month, the last 2 months, the last 3 months? Or how much did I make last year in August compared to this year, right? So I'm always trying to build up that, I guess, aspect of your video game character, right? Is trying to constantly improve in that way. Another thing I've done, I don't know if you've done, is I've built these relationships with people where, I have one friend who's retired and we talk almost Monday to Friday on Facebook. Mm-hmm. And then it started off with 1 or 2 guys. Now I have 4 guys that we're all on a group chat, like on our cell phones. We text each other every day. Okay, what did you buy today? What did you buy today? What are you thinking about buying? What I mean? So I'm building these relationships with people who are like-minded and are also interested in growing their investments. And I basically got them all into it. But yeah. And I think you have to have these groups of people because let's be honest, half of them are probably smarter than I am. So getting the feedback from them at what they're looking at and why they're buying certain ETFs and positions will help me pick the ones that I should buy as well. So I'm not just depending on my own, choices.
That's a good point. So I realized I was lacking that in my life. So the podcast serve dual purposes. I have guests like you on because I'm like everything you're saying, I'm learning from you. Right? I'm getting educated from you. Like I'm just absorbing it. I'm going to see what I can take, what I can apply. Also, after this, we'll continue to chat. We'll email each other back and forth, bounce ideas off each other, do whatever. Yep. So I'm building. but it was with that intent of I need to learn more, surround myself with people who are smarter than me in this industry. Podcast was a very easy way because I like talking to people and just asking questions. That's how I learn. So this is just this is a way for me to learn, and hopefully people learn along with me. So that's how I built my community. I launched the Wealth Academy thing. Now that's everyone's just sharing knowledge within there, right? Because and it was all built podcasts, the academy out of necessity. Because like you mentioned, I'm lacking this because I love my friends, but they're the same group of guys I've had since I was a kid.
Yeah.
And they could care. And like I said, I started the channel because nobody was listening to me. None of them knew anything about investing. They just wouldn't invest. So I started a channel to convince them to invest in their TFSA. Yeah. So they could still care less. They're not really talking to me about anything. They don't care. They care a little bit about health. So they'll tell me their workouts and stuff. But that's the extent. Now, like when the April dip happened, they did have a bit of a chat group going like, hey, Gary, what are you buying? What are you buying? What are you buying? And then I told them, because now they're like, hey, we should take advantage of this. And I told them what I was buying, and they just kind of copied my trades. But they're my childhood friends. But really, like I said, the community that's been built since I launched YouTube, the podcast, the academy, it's really been it's been so crucial because now I'm getting just viewers being like, hey, that's what you bought here doesn't actually make sense for how you built your portfolio. This would probably work better. And I'm going, shit, they're right. they're right, because you can't be everywhere. Yeah. You can't be, and then I'll see other people talking like, well, no, you should change that. That doesn't make sense for what you're doing. Yeah. And it's just 10,000 heads is better than just one. Because that's what we're dealing with now with YouTube. We're dealing with thousands upon thousands. So, and that's what I mentioned, like when we went to gamifying and making income, having a finance channel, being a little bit public facing and having people going back and forth with you just makes you such a better investor and an income generator in general. And, me and you, all we can do is hopefully give back right information to other people so they can do the same. We can all grow together. But that's when I guess, I didn't have that till the channel, but now I do. And I'm really grateful for that. So that, do you think Blossom helps you with that?
Yeah, Blossom helps as well. But also you're talking about your childhood friends, right? I have some friends that I've grown, close with in the small town that I live, where some of these guys have never even considered investing, right? They've never, they go to work and their work says, okay, you put money into your RSP, we're going to buy you these mutual funds, we'll give you a 5% add-on, and that's it, right? They don't have a TFSA, they don't have any personal investments, they don't care, right? And then I started talking to them about it, and now they're like, well, this is awesome. They'll text me, hey, Paul, I just got paid today, I put another $500 in my TFSA, what should I buy? We'll look at what they have and what they need. But so I feel like I'm able to help people, you know what I mean? Like I've been able to help some friends get rolling, get started on their investment journey as well. And now they're starting to realize maybe I don't have to work till I'm 65. I can actually, there's some of them are in their early 40s and they're thinking, well, maybe I can retire at 50 if I just keep, putting money into my my TFC. I've got one friend who had nothing outside of his work and he's getting close to 100,000 now. So he's so excited. So I like that aspect of it too, just trying to help people, whether I know them or I don't know them, because I don't know about you, but I get messages on Blossom all day long.
Constantly.
And, I try to help people as much as I can, as much as you can in just a few text messages, right? But it's a lot of fun trying to help people out and seeing people successful.
It's life-changing. When you have that investment backup, it gives you peace of mind. Same with you. I get emails daily at this point. I have a hard time keeping up, so I apologize if someone's emailed me and I haven't got back. Yeah.
It's impossible.
Yeah. But so that's why I joined the community, guys, that I have. It's a lot easier there than trying to email me. But
send me a link.
Yeah, it's just right there. If you go to GaryGillX.com, I'll send you a link for it too as well. You can just sign up and it's free. It's just it's a community that Discord community we have. But I was gonna say it's never too late to start investing as well, because Darren, the crazy Canuck investor, he's pretty active on Blossom. I interviewed him on the podcast.
That's another
50 years old.
That's another guy. Well, him and I are the same age. We're like a month apart, right? So that's.
But you started years ago. Right. And you started you switched over in your mutual funds later in life too as well.
Yeah.
He had nothing. I don't think he was doing anything until he was 50. Yeah. And then he's like, now, what? So it's you're not too late. That's what people need to hear more about that. Right. Yeah. Rather than the 20-year-old who started.
Yeah. Darren's a great guy. He texts me or messages me, and he's helpful. He's encouraging. He's a really nice guy. Yeah. I'm actually I'd love to see more people subscribe to his channel, because he does great videos. And especially for, our age group, not your age
You're
group,
gonna
but for
see
our age group.
he's figured it out. Like his viewership should start going like this now more
Yeah.
because he realized his story is what's compelling.
Yeah.
When he first did his content, I think he's a little bit too broad. It's like, no, no, no. Tell me about what it's like as a guy who just started investing at 50 years old. Because there's more of that than there is of some 18-year-old. All these like more people are going, what the hell? They knew who are 50 who like thought investing was like gambling or just had mutual funds. They need to hear more about that.
Yeah.
So I think now that he's sort of figured out that that's sort of like he needs to be teaching these people because they're the ones who really need his help.
Yeah.
You're just gonna see him like he's gonna just accelerate. I think he already is accelerating. If you look at his views, he's doing really well nowadays. So since he did that, so check out his channel too, or just watch his podcast with me.
Yeah.
So you mentioned we're at we did number 9 HYLD. We did number 10 QDTE. We did number 11 really quickly. I just want to talk about ENCL because that just sort of, because I'm not too familiar with it. Global oil and pipelines. Why did you pick that one? Just you want some niche kind of oil type?
So I believe so. Global X used to have a different name, and I can't even think of it right now. But it was a different company. They rebranded themselves. They came out with all these new. They took old I think ETFs. They changed them into covered call ETFs or something. And because oil's so volatile, ENCL dropped down to I think $17-ish, and the yield was all of a sudden 21%. And you got to realize, like nowadays, people look at ULTY and all these other ETFs that are like 80%, 90%, right? Go back 2, 3 years, that didn't exist, right? You had HYLD paying 12%. All of a sudden, you have ENCL paying 21%. It's like, I got to get some of that. I grew it. I
Yeah.
grew ENCL, I think at one point was $75,000 in my portfolio. It was a massive position.
Whoa.
It became my number one at one point. Um, and then what happened, Gary, was, whatever price I bought it at, it jumped. Like oil all of a sudden became popular again, and it jumped up close to $22 a share. So I started selling off, 100 shares, 100 shares, 100 shares, and just locking in those gains and then moving the
Yeah.
money into, whatever else was new at the time. But it just consistently pays. Now, I think at one point they did drop their distribution a little bit because oil's been down for a while now. But if you look at all the distributions that I've made, plus all the capital gains that I got from selling shares, it's just been, it's probably one of my best ETFs, even though right now I'm under. So what I'm doing now is I'm dollar cost averaging. I'm buying it every
And it,
month, and I'm just waiting until, at some point in time, something's going to happen. All of a sudden, oil's going to explode, even if it's only for
yeah.
a week, a month, 2 months, whatever. As soon as it explodes and gets up over $20 a share, I'll start selling them again. Right? It's
Yeah.
one of those ones that I know so well that I just play with it. I just hold it, buy more, keep collecting the distribution, and then once it shoots up again, I'll unload it, wait till it crashes again, and buy it back.
I I'm gonna think of how I can effectively say this without rambling. They always say time in a market beats timing the market, and I think that is true for
Yep.
most investors who can't track it daily or weekly. I 100% just keep your money in the market, buy at the beginning of the month or the end of the month, and just like rinse and repeat. And so you're only checking your portfolio 12 times a month at most. But man, if you have your pulse on it, timing the market beats time in the market
Yeah.
every single time. Every single time. It's like, what's that thing? It's like if you miss the top 10 best, the top 10 dips of the S&P 500, here's what your income would be. And if
Yeah.
you
Yeah.
captured it, being in the market, make sure you capture those. But if you time out to just mass buy during those dips, it's like you're like all my gains, all my massive gains are from timing the market.
Yeah.
Everything is time, but I'm looking at the market every single day. So I think if you're an active investor, you're someone who's gamified investing like we have, where it's something that brings value to your life, you enjoy it. It's a hobby that just generates money, and now you're like left. Like it's just fun. You're not. God damn it! Time that market. Pay attention to it.
Yeah, if you can do it
But
right.
keep buying on dips like we do, like on the ETFs and stocks that you have high conviction. Like try to only own things that you're like you believe in if you can. I believe in HHIS right now. It's kind of new, but I'll keep
Yeah.
buying that one. But yeah, that's just sort of like a little side note I said where, time in the market does always beat it. But if you are an active investor, timing the market is what
Yeah, and
wins.
I
So
don't think oil is going anywhere yet, right? Maybe someday, they're trying to put out electric cars and all that, but oil is so
no.
ingrained into our culture and society that it's not going anywhere. And it's cyclical, right? It's not really one of those
Yeah.
ones where you can buy a stock and it's just going to keep going up. They go up, they go down, they go up, they go down. So if you can buy them on the lows and sell them on the highs, and in
Yeah.
between, the best thing about covered calls is in between, I'm collecting that dividend. Right.
Yeah. Yeah.
If I own Suncor, I might be getting 4 or 5%. By owning ENCL, I'm getting like 18 or 19%.
Really quickly, how long do I have you for? Because we've been chatting for a while, so I know I'm not wasting too much. I'm not wasting too much of your time.
Yeah, we can keep going. Yeah.
Yeah.
Yeah,
All
I'm
right.
good. I'm good for a
Um.
while.
All right. Cool. So we are at number 11 ENCL. What are some ETFs that you have in your portfolio that we can kind of walk through here, and I can write them out that you
Um,
think are worth
so
noteworthy?
so another one that I have that I really like that I don't know if I would start buying it today if I didn't already own it, but have you heard of YTSL? So it's
No.
you know how there's TSLY, from
Yeah. Yeah.
YieldMax and
Yeah.
TSLY from Harvest.
Yeah.
Well,
Yeah.
before Harvest came out with TSLY, Purpose in Canada came out with YTSL. And they
Uh.
also have ones for I think Nvidia and a few other stocks, but the only one I ever bought was YTSL. And my average cost I think is around $19, which is not bad. It's currently maybe sitting around $20. I have one friend who caught it at 11. He caught the bottom.
Oh.
He bought it at $11, which was fantastic. It went as high as 36. The last time Tesla went on a run, YTSL went as high as $36. So I was selling it in increments as it went higher. I got to like 29. The problem is, Gary, I would sell it at $21 and then it went to 25. Then I sold a little bit more and then it went to 29. And I sold a little bit more and then it went to 36. And I thought every time I sell, it goes higher, right? So I feel like I'm timing it wrong, right? So I didn't sell any. And then of course it went from 36 all the way back down to like 20. Um, but nonetheless, I made money all the way along. And
Yeah.
YTSL just increased their dividend to 60 cents. So they started at 30 cents. They jumped from 30 to I think 40 to 55, now to 60. There was one period where they brought it back down again. It's pretty volatile. You'll have to look at the dividend history, but right now it's at 60 cents. And the other thing I like about it is it pays at the beginning of the month. So it paid yesterday. So at the beginning of the
Mm.
month, I get $780 at the beginning of the month, which is nice.
Just from that one position?
Yeah,
That's good.
I have YTSL. I have 1,300 shares left. At one point, I was over 2,000 shares, but like I said, I was selling it off when it was going up. So
Why wouldn't you buy it again if you didn't already own it? Because you just said that they've been slowly increasing their dividends other than the one time they cut it. The prices, whatever, seems like a proper range for a volatile ETF. You said $11, so basically $20. That's like it's other than that crazy time it went up to 32.
yeah,
What I don't other like for a single stock ETF, it seems like it's behaving like it's supposed to, but it has a pretty good yield as well. Like, what's wrong with it? Is TSLY just better?
I think some people have done the math, and if you buy Harvest TSLY now because of how cheap it is, you actually are
Yeah.
getting a higher yield. The other thing is, I mean, if you're looking at this at $19 right now it's $19.85, and
Yeah.
you're getting 60 cents, or you can buy MSTE, and what's it at right now? $13 or something?
Yeah. Yeah. Oh, so you're saying compared to what's other
Yeah,
available,
yeah.
but there's nothing technically other than the price is at right now. There's nothing technically wrong with it.
No, it's fantastic.
Yeah.
Yeah, it's been great.
Kid,
And it seems to be really consistent, kind of like plus or minus just a little bit around $20.
that's good.
Yeah.
That's something.
Got to add it to
I
your
don't know.
list.
Yeah, it is. I'm gonna keep my eye on that. Is add to my watch list. I'm actually gonna add ENCL to my watch list as well. The only thing is, with ENCL, you said that was a bucket of companies, right?
It is. It's I think it holds 10 or 15 like your largest Canadian oil and pipeline companies.
What was the yield on that again? I didn't write it down. Do you have it in front of you, by the way?
Give me one sec. I'll tell you the yield.
Because I'm asking because moving forward, I'm going to stay away, other than MSTE, from single ETF covered calls. I'm going to
Right.
try to always have some level of a bucket. Uh, that's just where I'm at right now. I'm just trying to just not have single ETFs right now.
Yeah.
So I think ENCL might be a better, if I can get it at the right price, something to buy into.
Showing the.
It's fine. I can write it in after. I can look it
Yeah.
up after.
No
Um,
worries.
so so we have YTSL. What other ETF do you think is noteworthy?
I like CNYE from Harvest, the Coinbase one. I have four.
See,
Yeah, I have 4% of my portfolios in CNYE. So YieldMax came out with Coney. So Harvest came
oh
out with,
yeah,
yeah, Harvest came out with Coney as well.
yeah,
CNYE is basically Coney with leverage. So I
yeah.
think originally I might have had Coney, but I'll always buy the one with leverage. So I sold those and bought the one and bought CNYE. Um, I
If
have.
if that's 4% of your portfolio, so that's, I don't know, just 20%, $20,000 or something.
Yeah, it's I have $15,000 worth of CNYE. Now that's another one, Gary, where my average cost is say just over $11, and maybe a month or 2 months ago it shot up to like $19 a share. So
Okay.
I started selling some of it at like $14, but then I sold it at like 16.85 and 17 something. So I was selling it off at like, I think I was up 30, 40, 50% or something like that. So I was selling it off and I was putting the money into TSLY, NVHE, MSTE. So then it came back down to, I think, 13, just over $13. I started buying it back again.
Is that your typical strategy then? It's you hold on, you buy them when they're low. When they have sudden upticks in price, like a drastic shoot up, you're like, all right, cool. You just start incrementally selling off. So you're kind of like a covered call investing plus growth investing when the opportunity presents itself.
Yeah.
Ooh, that's here. I'll capture that. I'll
Yeah.
capture some actual capital gains. Well, yeah.
I think you have to take advantage of the volatility in these funds,
Yeah.
right? Because some of them go on runs and you know what it's like. Things become overpriced, right? Once you start hearing that they're overpriced and you can see them skyrocketing, eventually they're probably gonna pull back a little bit or tank, which is exactly what it did. So I
Yeah.
don't do it
Like
with everything. Like some things like HYLD and HHIS, those are just kind of like my foundation. I don't want to play with those. Like I just leave them alone. But then you have some of the other kind of like single stock ETFs that are more like high flyers. Yeah, and every once in a while they go up too much, sell some off, buy something else that's down. And you can increase your monthly income that way as well. I'll only do it if I can increase my monthly income. If I'm not going to sell one and buy another and my income goes up, then I won't bother. But
then what about, let's say, a scenario, because with like HYLD and HHIS, I don't even think they would have upticks like that because they're just not set up to have that drastic of an increase like overnight.
yeah,
But something like MSTE is, but like I'm at, let's say, I don't know, we said like $13 per share. If it jumped back up to like $19, right? Would you try to capture that? But then what are you going to replace it with to get that same yield?
that
Because then you're technically losing then your
yeah,
monthly income
that's the
if you
problem.
don't equate.
You'd have to look at what else is available. Is there anything else you can buy that's gonna bump up your unless you feel strongly that MST shot up to $19-20 and in 2 weeks from now it's gonna be back to 15.
I would
But
1000% feel strongly that was going to happen.
the
I
other
would,
thing is,
I
Gary,
would.
if it shoots up to $19 or $20, there's a good chance they might increase the distribution. So sometimes I hold on to it thinking if I sell it, they're going to increase the distribution and then I'm going to kick myself for selling it. So,
Yes, that's a good point as
yeah.
well.
So,
Yeah, that's something to think about. I think off the top of my head, I would probably sell it. I would use some of it to make because I'm trying to make my portfolio a little bit more conservative by building up those other positions. I use some of that income, and I think I am trying to reduce my MSTE position just a little bit now. I think I am a little bit overexposed in it. So just because where I'm at, I'd probably sell a
Yeah.
portion of it, use it to build other positions. Yeah.
Yeah. I mean, if you are doing what you're doing, where you're DCAing and you're buying MSTE just to bring your price down, but now you're getting
Yeah.
to a point where you're way too into it.
Yeah.
Yeah, it shoots up
Yeah.
to $19 a share, and you can, what, on 1,000 shares, you can make whatever, $5,000 or something like that. Sure, why not sell it? Because that's your plan, right?
Yeah.
That's your plan. That's the thing. People don't have a
Yeah.
plan with these. They just buy. Oh, I'm going to buy $20,000 worth of MSTE at $19 a share. Right. Then it drops down to
Yeah.
$15 a share and they're panicking. So, but you have to have a
Yeah.
plan. Yeah.
That's a good important note because I do have a very clear enough at this point strategy of where my end point is. So I'm just trying to pull different levers, make different moves to get to that point.
Yep.
I'm not flying blind here. So you do need. Gosh, that is really important. I think everyone who's using this strategy, do you have a clear plan? Ask yourself that. What are you trying to get out of there? What does your long-term portfolio look like? What's it earning you? All that stuff have it mapped out. Don't just buy stuff and get excited.
Yeah.
Take it seriously, I guess, is what I'm saying. Okay, so we have CNYE. That's an interesting one. That's number 13. Let's get to number 14 if you got anything that you think is worthwhile.
What else is so now? Do you want to stick with just Canadian listed, or do you like the US listed as well? We did talk about T-SPY.
Yeah.
I mean, I own YieldMax and YMAG. I do own both of those.
Talk a bit about those. Those are US. Those are YieldMax. Again, I'm assuming. Those are probably held in an RRSP account as well too.
Yeah, I have both of those in my RSP.
I'm not familiar with them.
To be honest, I have 500 shares of YMAX in my TFSA and 500 in my RSP. At one time, Gary, I decided to open up a small US account in my TFSA because the yields on YieldMax at that time were so high that even after the 15% withholding tax, you were still getting over 30% yield. So to me, it made sense. There was nothing in the Canadian market that beat it at the time.
What is YMAX? What is YMAG exactly? What are they comprised of? Because I'm not familiar. I don't know too much about YieldMax.
So YMAX is like HHIS. YMAX is the fund of funds, right? Take all of the YieldMax single stock tickers like TSLY, PLTY, NDDY, and just put them into one fund. So the theory behind it was it's going to be more stable. You won't see the same NAV erosion or share price swings. So it was supposed to pay less but be more stable. And I think I started buying it around $20 a share, and now it's about $13 a share. And I've brought my average cost down to around 17. So it has come down. Like when the market, the problem is it holds everything, it holds all the single stock ETFs. So when they drop, it's going to drop as well. So it might have smoothed it out a little bit, but it did drop quite a bit.
What's the yield on that one? You said 30%?
It's about 30
after withholding?
Yeah.
Those are crazy. Oh, what about YMAG?
So YMAG,
what's that?
It's the Magnificent Seven. So they just
they
just took the seven. Yeah. What is it? Apple and Google and Microsoft, whatever. They just took those and put that into a fund. So.
And what is the yield on that? Do you know off the top of your head?
No, I'm not sure off the top of my head, but the weekly, they pay weekly. That's the other thing. They pay weekly, which is nice. But the weekly distributions for YMAG I've found have been not high enough for me. So what I said was every week that it pays less than 10 cents, I'm selling off 50 shares until I have none of it left.
Fair enough.
Yeah.
Do you have a lot of those weekly pay ETFs in your portfolio? Because that's interesting too. Eugen Vasquez, he's a U.S. investor. He was on the podcast. He's supercharged. He's U.S. investor, right? So he's all in on weekly pays. I think most of his stuff is weekly pay, and that guy's he's on overdrive. He's doing really, really well. And he's all over. He's in it every day. He's in the markets every day. He's buying, selling. He's just full out. He's doing it as well as you can humanly do this kind of stuff. So, but we don't, as a Canadian investor, we don't have Canadian listed ones. Like I would have to buy like a YMAG and stuff. How do you feel about them? Did you own them because was the weekly pay alluring? Like, oh, cool. Like I get a weekly pay out of it. Is that like one of the main selling points for you?
Yeah, I think that it was Roundhill, right? Roundhill came out with QDTE. I think was the first weekly.
All his Roundhill, he owns 80% Roundhill. 80% Roundhill.
Yeah. So they came out with the first weekly pair, and yeah, sure, getting paid weekly was definitely enticing. One of the reasons probably why I bought it. But I do have, so from YieldMax, I have ULTY, YieldMax, and YMag all pay on Fridays. I have one fund, might be from Roundhill. I don't know. It's PLTR. So it's based on Palantir, which pays on, this is the other thing now. These fund companies are trying to pay different days of the week so that you can have it where you get paid Monday, Tuesday, like literally every day of the week, which
they're looking at what the other guy has and be like, okay, he's Friday, so I'll make ours Wednesday. That way they know someone will buy them just so they get paid on. That's how you do it. That makes sense.
It's honestly like, that's how addictive it is. It's like people can't go a day without getting paid, right? And I don't know if that's necessary, like, to be honest. I am looking at buying Mag Y. So instead of Y Mag, they called it Mag Y, and it pays on Monday, but I'm looking at it because apparently it's very stable. Like the price has appreciated and the dividend is still really good. So I'm thinking about adding Mag Y. So I have the one that pays on Tuesday, which is PLTR. And then on Fridays, I have QDTE from Roundhill. I have QQQY and WDTE from Defiance. And then I have the three from YieldMax. I'll be honest with you, Gary, I do like getting somewhere between $500 and $1,000 Canadian on Fridays. Like if I can get that every Friday, I do like that. I'm not going to lie. I'm not going to lie about that, because Harvest and Hamilton and Evolve, they all seem to pay on the 8th or 9th of the month. So you get like, you get your large influx of money on that one day, but then kind of like nothing else. So it's nice every Friday to get another $500, $600, $700, $800 on the Fridays. It's fun too.
I think it is nice. I'm just trying to think of like my perspective. Like I remember when I used to like work for companies, I used to get a paycheck every 2 weeks. Right. And that's like, I think that's standard. I used to get a paycheck every 2 weeks. But then when I started running my business, there's invoicing, and we don't get the invoices from clients it's every month.
Yeah.
I always forget about I just forget the clients get charged, because like when I go 30 days, I don't think about it anymore. Like I just feel like, and I'm always like a little surprised, like, oh yeah, there's money there. Like, cause you forget for 30 days, it would be, but it is a nice feeling, like getting that money, like seeing it, you're like, oh yeah, every week, like it's like a reminder, it's there. And I think that's when I was looking at Q Day essay was like the main attraction for me. I was like, oh, it would be kind of nice to see it coming every 2 weeks.
Yeah.
Because like we have the payments come on the 9th or the 8th or 9th. Like, because it's a month, it's like there's a countdown to it. It's like, all right, let's see what happens. It's like, kind of want to get away from that a little bit. I prefer there not be a countdown every time I get paid. Like with my business, I forget. Like that's why I don't do invoicing anymore, because when I first started, I used to do invoicing, but I forget to invoice people because I'm running a business. I'm not thinking, like, I forget it's 30 days. I'm like, oh yeah. So like, obviously clients love it. They're like, we're getting free work. But I'm like, oh shit. So now I don't handle any invoicing, because like we're never going to do it, because I'm doing a bunch of other stuff. Yeah. But, for every week would be kind of cool when you're doing this, because these are US listed. Do you have US currency, or are you just you're just paying the conversion fee on all this stuff?
No. So the great thing about Wealthsimple is that once you have a portfolio over 100,000, at least this was the rule a couple of years ago. Once you have a portfolio over 100,000, they'll let you have US listed accounts for nothing. There's no extra charge or what have you. So now, if I was to deposit $1,000 Canadian to get it into my US account, I would have to have a conversion fee. But all I'm doing is using the distributions from the funds that I currently have to reinvest into US listed ETFs. So I rarely transfer money. I might, like if I get a $500 from HYLD and I really want to buy a US stock, I might convert it to US. Otherwise, I just stick with the funds I have and reinvest.
Wow, that's actually good to know. You mentioned Defiance ETFs. I've heard good and bad things about them. How do you feel about their ETFs? I think, what are the ones you own from their WDTE, or you own from Defiance?
Yeah.
What is that whole? Okay, I wrote those both down. I'll write them as number 15, those two.
So it came out as JEPI, but with a Y. So you know how there's JEPQ and JEPI with an I? So they called it JEPI, but with a Y. And I think they got in trouble for it. So they had to change the name to WDTE, whatever that stands for. I don't even know. Yeah. So I think that, is that the S&P 500? I think it's the S&P 500. But Gary, it was another one of those. So Defiance, I think Jay Pestricelli from YieldMax has something to do with Defiance as well. They like help with the calls or whatever. And they came out as being like, we're going to be a really ultra high yield product where we'll pay you, where they, I can't remember if they were weekly. A lot of these ones went from monthly to weekly because of the demand, right? So many retail investors wanted weekly that they converted from monthly to weekly. I think is one of the ones that converted. But they were another one like ULTY where they were paying such a high distribution, but their share price was tanking. And people were getting so upset about it. So they did a reverse split. And, whatever I initially bought at, I mean, my average cost and what it's worth today is it's not close, right? But they finally seem to have stabilized it. If you look at the share price, it's kind of more stable now, and they don't pay as much as they used to. So they're not necessarily bad. The thing is, I just haven't been building those positions. That's the problem with having too many positions, is some of the ones you should be building, you're not building anymore. You're not taking advantage of the lower price. You're not dollar cost averaging. You're just kind of letting them ride. So that's what I'm doing with those two right now. Just kind of let them ride and pay. I'm thinking about selling off the smaller position and putting it into the other, and then just working on building that one up.
Which one was the smaller one, WTE or QQY? Probably
QQQY, I have 24 shares. I only have 24 shares of QQQY. And WTE, I have 98 shares now because I just bought 6 more. I have 98 shares. So yeah, I'm thinking about getting rid of QQQY, put it into WDTE, and then maybe build that up to 200 or 300 shares.
I don't know why. I don't like looking at low shares when I'm looking at my portfolio. It bothers me knowing like I get 10 cents per something. Yeah. So I'm just like, unless I'm going to build it up, I'm like, I'll just liquidate this and put it somewhere else or something bigger. I know it doesn't actually make, it's not, there's no negative effect to it for visually for some reason. Like I don't like having like 10 shares of this. It's like, unless I'm going to build it, I don't want to own it sort of.
I know that's what a friend of mine says. Unless you want to own at least 100 shares of something, don't bother.
Yeah.
Don't bother buying any if you don't want to hold at least 100. Yeah, somebody commented on one of my videos saying like this QQQY is only paying me like $5 a week. Like, why even bother holding it? I mean, $5 times 52, it all adds into the $10,000 a month. But yeah, it really seems insignificant, right?
Because you forget you kind of own it and you won't be looking at it as closely as everything else. You're looking at MST and HHS way more closely than you're looking at, QQY, because you're like, the money ratio. So you'll make better investment decisions with those ones than you will with the other one. And you'll miss opportunity, like you mentioned, just by the nature of.
Yeah. And see now, remember I told you about Tap Alpha, right? So they're coming out with their new TDAC in September. So my priority is going to be buying that ETF as opposed to adding to my Defiance ones. So that's the problem, right? It's just too many positions all at once that I'm working on.
What is the ratio of US listed to I'll wait till the dog stops barking. Yeah.
I'm barking at my wife.
What is the ratio of Canadian listed ETFs to US listed ETFs in your portfolio?
Oh, you know what?
It's going to be more Canadian just by the nature of that you own MSTE and then you have HHS. You're going to have more Canadian regardless, right?
But the funny thing is both of those hold US companies.
Yeah.
It's all US, right?
Yeah, everything's US in the end.
Yeah.
Do you focus on Canadian companies at all, or just they don't naturally produce, they don't have the volatility required for effective covered call?
I used to more so, but I don't anymore. I think Adriano's right. We're probably better off focusing on the States for now anyways. But I like buying US listed companies through the Canadian ETFs. I think they're doing a much better job. And but like I said, I still have bank, right? So I got the Canadian banks, I got Canadian utilities, I got the oil. I mean, really, those are the 3 big sectors in Canada, right? Your banks, your financials, your utilities, and oil. So I think I have Canada pretty much covered.
Yeah, I agree with you there. I think bank and UTS will be my coverage, and then I'm going to do more research into ENCL and see if that can fit into my. I'm trying to keep my holdings as small as possible. I actually don't want to go over that 10 number, just because with all the other stuff I'm doing, it will actually become unmanageable for me. Let's do one more ETF, and then we'll wrap it up. Just because you just been really great. You've been very gracious with your time, and I appreciate it. But I don't want. I can talk to you forever, and I just don't want to do that. So let's pick one more. What's a good one we could end this off on?
A good one. What else do I have? I'll give to Ari. You know Ari Gutman?
Yeah, he works with Defiance, doesn't it? Yeah.
I think he works for Defiance, right? So so what happened was, because their initial ETFs they came out with were tanking so badly, a lot of their investors were saying, why don't you just come out with an ETF that pays less, but then you don't have the same NAV erosion or price share decrease or whatever. So they did. They came out with what they called their Target 20. So you have SPY-T and QQQT, right? And basically they targeted a 20% yield, but that's based on the current share price. So I started buying those. I think I ended up buying 200 shares of each. And, back in April when the whole market tanked, they did drop quite a bit, and it would have been a fantastic time to load up. Like, they were down around $14 a share. You could have bought a lot. And now they're back up to around $18, $19 a share. So I'm not quite getting the 20% on my cost, my yield on cost, but I'm probably getting 18, 19%. I actually started buying more SPY-T last week. I decided I'm going to start buying more of it. And it's another one of those ones like YTSL where it pays at the beginning of the month. So it paid me yesterday. So it kind of adds to my beginning of my month. So I like those too for relatively safe. I call it like, what I was saying is that I can sleep well with those two. I don't even think about those two. I forget they're in my portfolio until the distribution comes at the beginning of the month. And then it's like,
that's nice.
Oh yeah, I still own those ones, right? And then I look at, okay, so I'm down 1% or 2% on the share price. But if you calculate how much I've earned in dividends, I'm way ahead. So
they made it into a good core holding type ETF that's stable, reliable.
Yeah.
That's good. That's good to know. As US listed, unlike which HYLD and USCL. So in SPY-T, SPY, that's what that is.
Yep.
QQT is just NASDAQ. That's what that is. There is a US economy right there.
Yeah.
That's interesting. And it's got a 20% yield on the share price, which is pretty good, and especially if you bought in at a lower price. So
I know I really missed out. Really missed out, but
that's a good one to know about too. I have a question. How did you get into making YouTube content then? Because you said you were working you're working a normal job, and then you just turned on the camera one day and just started talking.
No, you know what? So I joined Blossom back in November of 2023, and I make very simple posts. Like, there are some people, like, I can't even read their posts on Blossom. They're so long, and it's like a textbook. Like, again, I said, there are people who are a lot smarter than I am, and they do these posts on Blossom that are very textbook-like and a lot of great information, but it's too much for me. I'll take a screenshot of something like ENCL. I'm up $2,000. I made $800 in dividends. Fantastic. And I just kept posting like that, and people, they liked it, so they started following me on Blossom. Next thing you know, I've got like 4,000 followers on Blossom, and then a month later it was 5,000. So Mo,
nice.
Mo from Momentum Finance.
Yeah. I interviewed him.
Yeah. So Mo reached out to me and said, "Could I interview you?" And it was like, Sure, yeah, that'd be great. I mean, this is what I do. I talk about finances either with you guys or just with friends, right? So he interviewed me. And then Ari reached out to me. He said, "Can I interview you?" And it was like, "Yeah, sure, you can interview me." And then I guess my wife and my friend's wife started talking behind the scenes, and they came to Sean and I and said, "You guys got to start a channel." And I'm like, Slow down. It's not as easy as you think, blah, blah, blah. And they just kept going on us for a few weeks, and finally decided, let's do it. Let's just start a channel. So we sat down at the kitchen table, turned on a cell phone, and made a video.
When was that? When was that?
July 18th. So it was July 18th. We started the channel, and it took us about 10 days. We got 1,000 subscribers. And I think, like, I've watched some other people.
That's a lot.
Yeah, I've watched some other people where they say, like, it took them about a year to get 1,000 subscribers. And we did it in 10 days. And then Marcos, Marcos, he interviewed me, and he put out the interview. And within 3 days, we got another 1,000 subscribers. So that
Wow.
really helped, really helped bring us up. And yeah, and then I tried to do a video a day. My goal was to get us to I guess we already passed 1,000 subscribers, but we needed 4,000 watch hours, right, to be monetized. So my goal was just to keep putting out videos as much as I could. It got a little bit overwhelming, so I would take some weekends off in that. But yeah, that's kind of how we got started on it. I've always kind of wanted
Wow.
to have a YouTube channel, but then my mind sometimes works where I think, there's already 100 other YouTubers doing this. So why does anybody want to see me talk about what everybody else is talking about anyways? But
I don't know, but my thing is your unique perspective, your unique situation. There's so much to learn there. I really need you to talk and explain what you're doing. So I sort of that it's value. It's a value add. I found like in the finance space, it was just a lot of people who were very polished, saying all the right words, giving out basic information, but nobody was actually telling you how it works and feels and what's happening and what the reasoning behind it. And those channels all blew up and they're all doing really, really great. It's like, it's just like very blanket of like,
yeah,
here's how you make $10 million and you buy this, this, this. And they're just saying words, but they're not being like, I actually own this and this is what I actually own. Like,
yeah,
here's what's actually happening. That's what investors actually need. I need case studies. I come marketing back. I need to see what you're doing
yeah,
and go, oh, okay. I don't agree. I agree. I don't like. Great. I'll take the parts I like. I respect though, because you're putting it out there. So no matter what, I'm not going to ever say anything negative because I respect it. Because Jesus Christ, you're putting it. It's very people don't get it. You are putting out how you manage your finances to the public. Like this. So and the amount of people who come out who say nice stuff is great, but then you get shit on by random people who say something, and this is like, what's going on here? Right. So like it's I think from my perspective, it's like I'm grateful that you're willing to teach people, show people what you're doing. You're transparent about sort of good decisions you made, bad decisions you made. You're telling me you bought in this price, but you're not too great here. Like so useful. Like I do not know. It is like you cannot get this from reading a textbook. You cannot get this by watching a bland investing video. You can only get this by listening to you talk about your experiences, why you bought something, why it didn't work. It is so valuable. So for me, it's such a value at having you turn on the camera and talk because you're helping people of your age demo. You're helping people like me who are looking for opportunities in the covered call space. Like, oh, because you have such a large portfolio. You've done so much testing. You've figured out what works and what doesn't work. It's like, great, man. You're saving me money. You're
yeah.
essentially saving me money. And I'm hopefully when I do my content, I'm saving other people money. That's why I go like, here's what I own, here's what I bought. They say, because they go, we're not going to do what Gary did because he just lost there. Like there's a lot to learn from it. So
Yeah.
for me, it's clear as day why it's a value add to everyone watching. So like I said, I'm just happy you do it, man. I'm just,
Thank you.
yeah, so,
And
yeah,
I don't know about Gary, I don't know about you, but like I find like I watch a lot of different channels and I watch
yeah,
people talk about dividend growth stocks that I don't even buy, but I
yeah,
learn so much about companies and investing, right? And the other thing is
yeah,
that like I don't know if you know Robin Haney, but I watched him since he started. I actually
yeah,
went back when he first started. I went back and watched like 6 months worth of videos just to catch up. But
yeah,
even though he's more of a VFV, VDY kind of investor,
yeah,
just watching his videos keeps me motivated, right? That's what it
yeah.
keeps me in the game. It's like I'm always, I don't know if that makes sense to people, but it helps me to stay motivated just to see what you're buying and what he's buying and what Adrian's buying and what's new on the market. It keeps me. I think if I didn't watch these videos, I would forget about it and I wouldn't do anything.
I use people like yourself. Like I know Robin Haney. There's another great guy, Bassam. All these different
Mhm.
guys. Like Kyle Livingston. Yeah, just Kyle Livingston. There's all these guys, and they all have such. They're all sort of like uniquely in their own event. They all have such diverse styles of investing. It is like the way it's made me such a better investor. But they're my research tools.
Yeah,
I look at these guys. Eugene Vasquez. I can't say enough good things about him. This guy gives me the best. I actually don't even read market news much anymore. I actually go to his channel.
yeah,
I see what he's looking at because we have our eye on the similar tech stocks. He gives me the update a couple times a week in his videos. I'm like, here's what's happening. Here's what's happening geopolitically. I'm like, boom, I got it. So like this network of finance guys who all have different styles, different interests, different ways of doing it is like my IV drip of just like hit me hard with all this stuff. And then I go off and do my own stuff. And then a lot of what I'm doing on the channel is I'm aggregating all these other guys together, taking it all and then creating a video about it and talking, or I'm just literally bringing you on. I mean, like, and you just talk, right? But that's really what's happening now. So like all these people we're so lucky in an age where we have all these tools available. People like you, hopefully me, guys like Bassam and everyone else are just tools for the audience to become way better investors. Because God, imagine if all these guys I've interviewed you guys. I've interviewed everybody. Nobody is malicious. Nobody has some evil corporate scheme. Everybody is a regular guy coming from a regular background who is a do-it-yourself investor who's managed to accumulate wealth the hard way of just research, learning, trial and error. And now they're just taking time of their own day to build YouTube videos, to no views when they start. You were pretty fast, but most of these guys weren't very fast, build up an audience and doing it. Like they're providing value because they all come from the same thing of like, we just like educating, we like teaching. So like for me, grateful, like Marcos, another amazing example. Marcos is a large reason why I even thought I could even do YouTube, because I spoke with him before, just as in the advertising world. I'm like, this guy's so smart. He's so intelligent. Oh, and I'm like,
he's so young.
So young. And after speaking with him, I was like, I'm like, I have a pretty big portfolio. I know a lot about this. I've been working capital markets for half a decade. Maybe I should do this too. I think I'd be like, after he motivated me without knowing to be like, maybe I should do this. I think I could do this. Like there's so much stuff. And I just met him naturally through advertising. So, I don't know where I'm going with this. I'm just like, I'm grateful for the community of the people here. And I've been pretty lucky to connect with all you guys. What can we sort of expect from you in the future? What's your posting schedule like? I know everyone can check you out on Blossom. They can add you there. They can subscribe to your YouTube channel if they haven't already. But, is there just more case study content right now? You're in a transitionary period in your life right now. Is going to be more commentary on that and sort of the decision-making process? Can we expect more of that kind of stuff?
Yeah, you know what? I do have, like, for example, every Wednesday, I talk about the distributions that are coming out for Friday. So my weekly pairs like YieldMax, ULTY, whatever. So that's just consistent. That's an easy video. I sit outside, I set up my cell phone, no edits, no nothing, just make it and put it out to the world. But then I have I don't know about you, but I have like at nighttime, I have like 2 or 3 video ideas just pop into my head. And by the morning, I forget some of them, but some of them stick. Or I get questions on Blossom. I get comments from people and it's like, okay, I need to do a video about this because somebody's asking me, are covered call ETFs long-term investments or are they short-term investments? So I made a video about it. So right now I don't have a specific schedule for videos. I'd like to put out 3 or 4 a week at least.
Yeah.
And a lot of our original videos were quite short. So I'm trying to make them a little bit longer than they were originally. Definitely I'm going to do like a monthly portfolio reveal. I'm going to do something about my retirement, because now my portfolio is more important than it ever was. Just going to be videos coming out depending on how the markets are going or what new investments are coming out. I guess I don't really have a specific strategy, but it all works in the end.
Yeah, it'd be great to have more long-form videos. There's some YouTube put out a report saying user watching behavior.
Yeah.
People are watching either extremely short videos now, like under a minute, or extremely long videos now. The middle is being removed, so that's a watch time. So that's why podcasts work really well and shorts work really well. Okay. The 10-minute videos actually don't do as well anymore because people just want one or the other, more or less. I think you doing stream of consciousness, sitting down, just talking, I think that works fine. No editing. You could easily pump out 4 of those a week. Just be like, all right, turn it on, talk. Have a nice thumbnail, have a nice title, you're good to go, right? Promote it on Blossom. All right, this was fantastic. I appreciate it. So today we went through everything. I could talk to you forever, but we've been talking we started meeting off camera 3 hours ago. So I gotta let you go. You need to eat. We probably both have to go. Pee. Okay, so that's that. I will talk to you soon. It was fantastic talking with you, Paul.
Yeah, it was. Thanks, Gary.